Oh, uranium, it's the best performing commodity this year. And I'm sure the question on your lips, definitely on mine, what inning are we in? Is the best still to come? Well, you come to the right place. We're going to try to answer that question. So buckle up, sit tight. This is Uranium 1-on-1.
Big show, let's go.
All right, everyone, Uranium 1-on-1. Welcome.
Oh, let's go, guys. We got a stock lineup. Scott, we got hats to give away. This is the hat, man. People have been popping on this, guys. The lineup is incredibly stacked. First of all, we got to thank our sponsors. We got Cuppy on deck, but let's thank our sponsors. Scott, hit it.
Yeah, so first we got Praetorian Capital. They're the kings of inflection investing. They're all about getting there first. And then next we have Goehring and Rozencwajg. They're the premier natural resource investors. Let's keep it on rolling. We got some more partners. Oh, we got Doomberg, the Green Chicken, #1 finance newsletter on Substack. He's at 200K subscribers strong. Check him out. And lastly is Grizzle Research and Quant. We're combining quantitative and fundamental research to identify mispriced opportunities in the market with compelling upside. That's Grizzle Research and Quant.
And then Sprott.
Ooh.
Asset management, of course, the leading global asset manager in precious and energy transition metals. Guys, it's a stacked lineup. We got some great companies. We got some great speakers.
Tom, we got to tell them how this works. So for anyone new to the stream, this is live, right? This isn't recorded. We're right here with you. You're here with us. So if you got questions, you got comments, put them right there in YouTube, Twitter. Maybe you can comment. Just let us know what's going on. We ask questions live to the guests. Maybe your question will get asked to your favorite management team or investors. So that's the beauty of Grizzle Uranium 1-on-1.
Let's do it. Let's bring up Cuppy.
All right, we got Cuppy on next. Oh, it's the man.
Hey, guys.
Cuppy, how are you, man? Thank you for kicking off Uranium 1-on-1. Always a pleasure.
Always great to chat, guys. I'm doing great. I'm excited. We're making new highs. It's good.
Yeah, it's a good time.
Oh, man. Cuppy, like, I still remember, us talking about the thesis. Those that have followed Cuppy have nailed this. It's been an incredible run. Cuppy, first of all, congrats. and as Scott said, is what's still in the tank. So let me kick it off. You wrote this incredible piece. For those who are following who don't, we're going to have the link in YouTube. Go to Cuppy's Corner. It's incredible. Wrote this vivid, hilarious piece, The Bigger Short. You gave investors a great inside view on the World Nuclear Conference and the oblivious fuel buyers unprepared for the coming squeeze. So uranium prices have spiked in the past, Cuppy. How would you describe the current supply-demand dynamic?
Well, it's a mess. There's just huge deficits. I think it's like 50 million pound deficit next year, and it grows the year after. Like, I don't know how it fixes itself because there's some mines that are turning on, but this takes a couple of years. And in the meantime, they're drawing down inventories. There's multiple days where there's just nothing on the offer. And I'm talking about the spot market and the term market. Everyone's sold out. And for the guys who are sold out, they're not hitting their own targets. I mean, Kazatomprom isn't going to hit their targets next year. Cameco's had some issues. A bunch of other guys are having startup issues. I mean, Niger had a coup. Like, they ain't hitting nothing. Namibia's having issues. Like, everyone's having issues hitting targets. And I don't know where the pounds come from. Like, if I was a utility, I'd be freaking out. But utilities, they don't really know. They read analyst research. I mean, I looked at a research piece this morning someone sent around, and I mean, they're talking about Russia supplying, secondary pounds to the market. I mean, Russia's short. Like, I don't understand who these analysts are. These guys have done no work at all. They just take everyone else's price decks and they just play some numbers around. It's insanity. And these poor utilities are listening to these Wall Street analysts or UXC or some of these other guys, and I mean, they're going to get run over.
So they're just like it's this thin. It's a smaller, obviously, commodity market, and you're just not seeing the insights you normally would for other commodities. I guess that compare and contrast, if you will. Maybe you can give us a little bit of overview on like how uranium compares to what you've seen in other commodities, or at least with respect to the depth and quality of supply demand forecasts.
Well, I mean, I just think there's less guys looking at it. Look, the smartest guy goes analyzes oil or something, like the fourth tier junior analyst, like the guy who couldn't get an internship at a real firm, he gets stuck on uranium because, I mean, there's only a couple QSIPs to trade. There's not a lot of banking business. Like, no one wants to do that sort of business. And so you get these kind of joker analysts. And look, it's really quite easy. There's two producers. There's Kazatomprom and then there's Cameco. And then there's a couple of scattered mines around the world, and that's it. And you just need to be skeptical about what those two big guys are saying. And you don't always have a lot of visibility on what's happening in, say, China or Russia. But we know Russia's short. I mean, they're panic short. And we know China's waving it all in. And then, you don't get so much visibility of what's happening at like Husab or Rossing or, but it's in the local newspaper. I mean, go subscribe to newspaper in Namibia. It really isn't that hard. There's like 20 mines in the world and there's like 50 consumers. This is so easy. This is just first grade.
Oh man. And so just on the point of Cameco and all the other big producers, what kind of like is it, is the risk here that they can turn on the taps really quickly? How are you kind of thinking about how they could respond and how quickly they can respond to this?
Well, I mean, Cameco's trying to turn on the taps. McArthur River's behind schedule. I think they're going to have some issues in Q1, but they'll get it figured out. But from there, Rabbit Lake is, another 2 or 3 years out. And, I think it's going to be harder than people think to ramp it up. Kazatomprom's in a world of trouble. Orano's, I mean, it's a neutron bomb's about to go off. You just kind of start looking around the globe and all these guys are trying to ramp. They ain't ramping. I mean, it's pretty obvious. And so we can look at it mine by mine, company by company. And we talk to a lot of people in the industry. They're not ramping. Look, eventually the price goes high enough and stuff will ramp. There's a lot of little guys out there that are, 500,000, a million, 2 million pounds, and they all add up. And they're, they got the wheels in motion, but they don't have the financing. They don't have the permits. But, when the price goes up and utilities scream, suddenly permits show up and funding shows up. But that's, a year or two in the future still. That's when you start selling, not now.
Absolutely. In with respect to just like when we think about the cost, right, and like this squeeze up, right, and how should an investor think about the fact that uranium is such a small part of the overall fuel cost of nuclear power itself versus, say, coal, where coal is over 90% of the cost of coal generated electricity? Is there a point where they scream uncle, and when does the pushback happen? Or is that the nature of the fact that this super spike can really hit new highs? Like, you can get to just astronomical numbers relative to what the market should think is normal because it's such a small component.
Well, one, it's a really small component. And two, most of the utilities have agreements where they have floors and ceilings. I mean, the big producers aren't going to see these crazy prices. If the price goes insane, I mean, that's going to be a couple million pounds a month, maybe. So there's some utility that screwed up their book, and they're going to be paying that. But the vast majority of the production isn't going to be paying that price. So I mean, who's going to cry? One utility that screwed up, like that's their own damn fault. I just don't see a lot of the utilities. Most of the utilities have ceilings in the 70s and 80s. Like they're not going to pay that. I mean, if the price goes to $1 billion, they still pay 70. Like it's not really an issue for a lot of these utilities. So I think that's great for the guys in physical, because I mean hopefully those trusts will roughly track the spot market, and it might be okay for some of the speculative juniors because you can have a speculative bubble, but I don't think it's going to matter to the utilities. I wouldn't worry.
Interesting.
Now, when we think about like how you've originally initiated the position, and when we last talked, it was through Sprott, the Sprott Uranium Trust. That that was the core vehicle, and you felt that Sprott had an ability to corner the market. Your view has evolved since then. Could you maybe talk about just how much bigger than Sprott this is?
Well, I mean, Sprott's done what Sprott needed to do. There was 40-something million pounds that it's purchased now, and it's tightened the market. And if they keep buying pounds, it's going to tighten the market further, and potentially they corner the market. But I don't think that's the thesis anymore. I think the thesis is you have a 50 million pound deficit. It's 1 million pounds a week, and I don't know where the pounds come from. If you turn all the switches on today, it's still 3 or 4 years before the mines come online, and even then it's not really 50 million pounds. Plus they're building a ton of new reactors. So look, I think Sprott is additive to what happens, and there's a bunch of other hedge funds out there that are buying physical. We know of a few of them, and there's a couple other entities being launched that we've got wind of, but I think that's just around the margin. I mean, look, Sprott so far the second half of this year it's bought 1.5 million pounds. Like that's 3 incremental reactors. It's just not a big number anymore. That it's not Sprott driving this. It's real demand.
I just wanted to ask about demand. I mean, is demand part of the story? Like, are you playing that this is just a typical cyclical restocking? They got it. They have 3 years of cover, and then the nuclear buyers say, well, I want to go out to 5 or something like that. Or is this potentially secular demand growth with the new reactors, small modular reactors, all that stuff? Like, how are you thinking about it? Does demand matter, or it's really just supply?
It's both. They're building a ton of reactors. I mean, think of this and be China. Okay, China is building a bunch of these reactors. They don't have a lot of uranium domestically. You don't want to build reactors and then not be able to fuel them. Like China, they're not going to build these things unless they think they have a 5-year stockpile. And China's also not going to go out there and just start selling pounds because the price went up and try to clip a quick scalp on a couple million pounds and make 100 million or something. That's not their business model. Their business model is making sure there's electricity, so the locals don't get pissed. And when you build one of these power plants, you better have 5-year stockpile. So China's going to be out there hoovering it up, and so will everyone else. I mean, it's the Western utilities that really screwed up, and the French. That they let their stockpiles go down. But let's say the Western world's 100 million pounds a year, and they want to restock 1 year worth. Well, that's 100 million incremental pounds. I mean, I'm using round numbers, and it's not precise, but there isn't 100 million incremental pounds. It's more like an incremental 20, 30 million pounds a year, which is why maybe the demand number in 2024 isn't 210, it's 250 or something. You have 4 years of destocking that now needs to go the other direction. And as the price goes up, I think a lot of these utilities are starting to panic. They're going to say, let's get some more. I mean, it's not like it's their money, it's a government utility, most of these things. French taxpayers will pay.
So, Cuppy, just with respect to global inventories and where you're seeing stockpiles, is that the unknown here, where we really don't have a full idea of the the nature or quantity of that, or maybe you have better clarity on that?
I don't think we know. If they found another 50 million pounds somewhere in a warehouse in like Uzbekistan or Kazakhstan, I'd say, okay, and it postpones things 6 months or a year. Like no one really knows, right? But when the price starts going up, that usually tells you that the mobile inventory is starting to clear out. I mean, if we're still sitting here at $30, I'd say, yeah, something's wrong with the thesis. But the price goes up and people keep selling it, and it's getting absorbed. But I don't think anyone really knows what the total number is. That's the opaque part.
And so, as we kind of move on from the Sprott thesis, and I know you still still own Sprott. How are you expanding this now that now the fact that you're like, okay, listen, Sprott's done its thing. It's a much bigger issue. Surely uranium equities start to become a part of your investment thesis. Just maybe you can kind of outline how you're looking at the landscape with respect to the full continuum from Sprott to the dinkiest little explorer, and where you're putting your fishing rod.
Oh, I mean, I'm not being very creative here. I mean, I don't want to offend any responsors. I mean, I mostly own Sprott and Yellowcake. I own the physical because I think it has the lowest risk. I mean, we're barely at the marginal cost of producing this stuff. There's not much risk, and I think Sprott can still 10 or 20x. Like I just think that's the I'm not saying that's the most likely outcome, but I think it could just do something crazy. I think it could also 3 or 5x, and I'm good with that too. And so I would just rather focus my energy there. I mean, look, I own some of the ETF. I own bits and pieces of other stuff, but my energy is really on Sprott because I think it has the most upside and the least downside. I'm not a geologist. I bet you there's people watching this show that can find some 10-cent stock that's going to $10, but that's not me. I mean, I wish it was me. It's not me.
I like your honesty.
Cuppy's a whale, man. He can't mess around with that stuff. But Cuppy, just on that specifically with respect to, okay, so you're playing it through the physical and you're going to get that. Is Cameco not an option for you? It's obviously had an incredible run this year relative to the smaller names, the mid caps. Just wondering how you think about a company like Cameco. Is that just not appealing to you?
It just doesn't seem attractive. It seems very fairly valued in my mind. I mean, they've locked in most of their production. They have Rabbit Lake they can turn on, which is a couple million incremental pounds. They can probably squeeze harder on Cigar and MacArthur. I mean, Inkai, they're kind of bottlenecked, and but it's all pre-sold. They could squeeze a couple million pounds out, but it's a very full market cap, and it just isn't attractive to me. I totally understand why a mutual fund would buy it here because if the price of uranium goes up, it all goes up. But it's just not very attractive to me. And, I'm in this to win this. And like I said, I think the price of physical can go to a couple hundred and maybe has 4 figures to it. And, if that happens, Cameco, it all goes up, right? But I would just rather be in the thing that I feel strongly about. And, when it comes to something like Cameco, I'm always worried that they have some mining issues. They have ore bodies that are very difficult to operate historically.
Yeah, we have time. So the other one, just with respect to the current supply demand mismatch and the sweet spot for this trade, Cuppy, do you see this resolving? Like, is this going to be like I blink and I miss it 6 months, a couple, quarter, or is this a table that gets set over the coming years? And how are you positioning your foot on the accelerator, so to speak?
Years. I mean, look, everyone watching this should take a list of every deposit and every junior that says we're building a mine, build a giant list of this stuff, put the date where they tell you they think the mine's going to come in. Most of these mines will never get built. And the ones that do get built will never hit their targets. But you just set it up and say, okay, these guys say, Q4 of 25. These guys say Q2 of 27. You just build a chart and say, if everyone does the thing they say they're going to do, this is how many incremental pounds come each quarter. And we've done that. It's not rocket science. And I'm not sure I'm very sure we're not going to be exact on this. But you can look out a couple of years and say there's not really a lot of pounds coming. And then you can look at every reactor that's getting built and say, well, this is how many reactors are going, and start with a baseline and say, we're in a deficit now. I think the number's 50, maybe it's 30, maybe it's 75. I don't really know. I think the deficit expands. And you could look at this Excel spreadsheet and say the deficit probably gets worse in 25 than 24. And we don't really know what the baseline is. And we don't really know how enrichment's going to play out. And there's some other variables, like is Niger going to figure their stuff out or not? Like, I don't know. I mean, how short is Irano? I don't know. I mean, how short is Russia? Like you have all these, things you can play through the ecosystem. And your net result is, I think you have a 2-3 year window before a lot of supply comes online. If everyone does the thing they say they're going to do, and I've been around mining for 25 years. I mean, I know you guys have been around it. No one ever does the thing they're going to do. And there's accidents along the way. And you're in funny countries where the rules change every month and mines get shut. And, things flood, things break. I mean, I hope no accidents on anyone, but accidents are what make the price go higher. And that's just the nature of this thing. And you kind of have the baseline. We know how much demand is going to be, and we roughly know where the supply is going to be, and it's a mess. I think the one variable we don't know is investor demand. There's tons of these entities being launched, and there's some really good talkers out there that are going to go to some rich guys and raise hundreds of millions of dollars and buy pounds. And Sprott and Yellowcake, they're going to keep doing the same thing. And a bunch of the juniors are going to have ATMs, and then they're going to do offerings like you, Roy, and buy pounds also. So that's the variable you can't track.
That's the interesting part here, where maybe in a past cycle, because you didn't have Sprott and yet you didn't have these other physical entities, that money would have gone to, say, explorers, developers, et cetera. Like, that capital is now like sitting in acquiring. It's almost, that's not going to net add to the market. It's net going to take away. Is that a fair kind of takeaway here? Like where the capital is going right now, it doesn't seem like it's going to the uranium equities themselves.
Well, I mean, I think some of it's gone to the uranium equities. Look, I think we're really early in this cycle. There's me and a couple other guys who've been pretty outspoken about this. There's about 100 assholes on Twitter, and that's it. Like I still mention this to my friends in the hedge fund world that control huge amounts of money, hundreds of millions, billions of dollars. And they're like, oh, it's just some assholes on Twitter. Like, no one ever, I go, you should be looking at this. Like, a Cuppy, I missed it. It was 31 when you told me. Now it's 80. I missed it. I go, you've missed nothing. It's a warm up. And then you need those guys to finally say, okay, screw it. I'm going to spend a Sunday and learn uranium. And it's coming. It's early.
Cuppy, always a pleasure. Now, I got to get a throwaway here on Project Zimbabwe. Where are we? You had that phenomenal T-shirt last time we did Commodity Con. Talk to us about Project Zimbabwe. We're close to liftoff here.
We're pretty close. They have the intermission right now, and they're still doing QT. And I think we're near the end stages. It might take till after the election, but I think they're going to flood the world with liquidity. I mean, in the end, the entire world is on the Mag 7, benchmark. It's 10-year bonds and Mag 7. Well, 10-year bonds started to leak. They panicked. They propped those up. Mag 7 is bid, but that's going to fall apart next. And I just think if you have a down 10, 20 in the markets, they're going to print money and prop it up. I think we're in this weird period where it's going to be kind of crappy at some moment, and then they're going to turn the switch, and you got to be long the day before they turn the switch. And I've kept a little dry powder, but I'm pretty fully invested. I think we're close.
Cuppy,
awesome.
Always a pleasure, guys. That's Cuppy, Praetorian Capital. Thank you so much, Cuppy.
Thank you, Cuppy.
Hey, thanks for having me. Enjoy your conference.
See you at the moon.
All right, everyone. The uranium train is just getting rolling. We're going to take a quick break, and we'll be back with John Ciampaglia of none other than Sprott, the owner of the uranium trust we just were talking about. Don't go anywhere. All right, we're back with a very special guest, John Ciampaglia. He's CEO of Sprott Asset Management. If you didn't hear, Sprott is the one behind the Physical Uranium Trust. We're very excited to have him join us. John, thanks for being with us.
Thanks for having me, guys. I don't know how I'm going to follow Cuppy. He was on fire this morning.
If anyone can do it, you can, John.
Absolutely. I feel like this is like a great play. I've got all the actors on stage. We got Cuppy, we got John. John, thank you for joining us.
Yeah. So let's dive right into it. So Sprott has been a leader in building commodity investment products for investors at the right time. That's the most important thing. Can you just take us through the discussions that led to the creation of your first uranium ETF in 2019? which was basically at the beginning of this current cycle. I'm very curious how you guys came to the conclusion now is the right time for this.
Yeah, sure. I'd be happy to give you a little bit of the backstory on how we came to be. It was actually about 5 years ago, just coming up to this December, where we sat down with the chairman of Uranium Participation Corp and started a dialogue with them about potentially acquiring the vehicle, which had been in existence since 2005. And at that time, we had a very constructive long-term view on uranium. And remember, at this time, price of uranium was in the 20s, right, per pound. So deeply out of favor. Some of the best mines in the world were on care and maintenance. And we just thought that the situation just could not continue for an extended period of time. Otherwise, you just have an industry that runs out of material once you work through your inventories and secondary supplies. And so, that dialogue with UPC, took longer than we had hoped. It took about 2.5 years. But we're obviously sure glad we stuck with it and we're persistent, because in July of 2021, Sprott was born, and we just crossed the $5 billion US mark in net asset value. And when we acquired the vehicle, it came with 18 million odd pounds of U3O8, which at the time was valued at $630 odd million. So the growth in the vehicle has been, extraordinary, completely blown away our expectations. Yes, we had a long-term constructive view on the market, but we would have never have foreseen the cascade of events that have played out. I would say they really started at COP26 in Scotland, where it really started with the world acknowledging uranium had to be part of this, nuclear power had to be part of the solution to hit any kind of net zero targets. And it was really, coming out of the penalty box, so to speak. And obviously it's just accelerated from there, spurred by a pretty nasty energy crisis that we saw in 2022, brought on by the invasion of Ukraine, which has really changed the psychology of, not just governments, but utilities. And I think it's a big part of the story here, that utilities have, largely been in a destocking kind of mind frame for the greater part of 10 years. And when you're destocking, you're basically, consuming more uranium than you're replacing. And what we've been really patiently waiting for is the moment where utilities finally get out of this complacency mindset and get back to replacement rate contracting, which I think we can say 2023 is finally the year. And the last time we had replacement rate contracting was 2012. So it's been a long time in the making. And remember, utilities are the primary owners and consumers of this critical mineral. They're on pace to purchase well over 150 million odd pounds through long-term contracts this year. And we think the cycle is just going to accelerate from here.
Great. That's a great setup here. Now, I wanted to move on to the SPUT, the Sprott Physical Uranium Trust. Can you walk us through the fund's objective and the mechanics of the fund, kind of how it works for anyone who's new to it?
Yeah, sure. So our philosophy is very simple. We want to be as transparent as possible. So when we took over the predecessor vehicle, we immediately changed the way it operates. We produce a net asset value every night. So we show the world what the value of the uranium is. We show all of our purchasing activity. So for example, yesterday we purchased 100,000 pounds of uranium. So that will go into our stockpile. Its objective is very simple. It's to essentially hold U3O8 uranium, which is also known as yellow cake. We have the ability to raise new capital when the trust trades at a premium to its previous day net asset value. And when it does that, we have the ability to instruct our underwriters to issue new units into the market. So you may come into the market, buy some shares, and have no idea whether those were secondary shares or they were newly minted treasury shares. So we've issued a little over $2.2 billion US in these new treasury shares since our at-the-market offering came into place in August of 2021. It's a very efficient vehicle in terms of getting exposure to, obviously, a commodity that's not easy to buy. There aren't great proxies out there. The futures market is barely exists. And our goal is really to provide, the world's largest physical uranium trust, continue to scale it, continue to improve its liquidity, so that as this bull market matures, more and more institutional investors can get involved in this sector. And I think that's worked out very well. The fund trades very close to its net asset value, with the exception of a few air pockets that we've hit over the last year. But I think it's fair to say it's been a huge success, primarily with institutional investors, which we think form at least 80% of the shareholder base. And so, I would say transparency and simplicity is really what has made the vehicle successful.
John, maybe just a question on the institutional buyers, and just maybe get a little behind the curtain, the conversations. What are they looking for? Are these types of institutional buyers that would have bought other commodities in the past, and maybe you can get a little bit of a makeup of these type of institutional buyers?
Yeah, well, it's changed dramatically in the last 2 years. I mean, 2 years ago, when we first started our discussions with different institutions, it was a small handful of guys like Cuppy that had done a lot of the early stage research, come up with the thesis and said, hey, this is really, really interesting. And at that time, it wasn't really a demand story. It was really a supply story. They were all focused on the supply, meaning that we were going to have a huge supply deficit unless the price increased and turned back mines and got greenfield, projects off the ground. But since then, it's become twofold. One, it's the supply story hasn't really changed meaningful, but now the demand story has become much more durable and I would say broader. But in the last, I would say, year or so, as the thesis is playing out and people are kind of taking notice of energy markets and understanding exactly what happened in 2022. Why nuclear energy provided incredible resilience through that period of energy shock that we saw in 2022. People are starting to do their research on the thesis. And I would say that the types of investors we're seeing have gone from specialty kind of hedge funds and energy transition or energy tech funds to much broader, I would say, investors. I think it's also fair to say that with uranium being in a bear market for as many years as it was, we would even stumble across dedicated commodity funds that would have had zero exposure to uranium. And that obviously you cannot ignore anymore, because you're gonna underperform your benchmark. So I would say that the breadth of investors has changed to more specialty funds, to more generalists. But having said that, we still think it's very early. This is not a crowded trade in terms of, everyone is rushing to get into this. We still find institutional investors are fairly early in their research process, are still trying to figure out the basic fundamentals of how this market works. It does not work like the oil market or the nat gas market. So they need to kind of understand, what are the key drivers that are behind the uranium market relative to traditional commodity markets.
Now,
great, thank you, John.
John, you made a comment on demand, so I just wanted to dig in on that. Do you think that is uranium going through a secular increase in demand, or is it still too early to say that? And we can say definitively it's a cyclical restocking that is happening. But do you think is there data in place that you think it's likely there's a secular change in nuclear demand, uranium demand?
Yeah, there's an absolute shift going on in demand, and it's coming from a few different ways. Think about a power plant that is scheduled to close. You're basically running that plant, with fuel to basically get you to that closure date. All of a sudden, the plant is no longer closing in 2 years. It's going to operate for 5 or 10 more years. That's an immediate, near-term demand requirement that power station will have. We've seen, PG&E come into the market recently this year and have an immediate impact on the uranium market because they need to go and buy 5 million pounds of uranium. There are countless examples of those life extensions. We obviously have seen restarts. So these are plants like in Japan that have been closed for years that are slowly coming back online. That obviously creates near-term demand for uranium. Then you're talking about all the countries that are thinking about building nuclear power capacity for the very first time. So these are countries like Poland, who essentially run their whole electricity grid off coal, who are probably going to build 6 to 8 nuclear reactors in the coming years. So that's all future demand that's coming. And then you have obviously the real, primary drivers of demand, which are places like China, India, Middle East, that are going to build, not 2 or 3 or 6 or 8, but they're going to build 20, 30, 100 plus reactors in the coming decades. That is really going to drive a lot of the new primary demand that we expect to see in the next 20 years.
Now, I wanted to move on to geopolitics a little bit. I wanted to get Sprott's take on the geopolitical situation as applies to uranium. I mean, have we seen any fuel buying or supply starting to move west in anticipation that there may be some supply issues from traditional suppliers like Russia?
Yeah, I mean, I would sum up the geopolitical situation with uranium as it's complicated, and the reason it's complicated is because you essentially have this critical mineral that is highly, highly controlled and concentrated in a very small number of companies and countries. And if I just kind of sum up, let's call them, non-Western countries, in terms of Kazakhstan, Uzbekistan, Russia, China, and I'm going to throw in Niger in there because obviously they're in the middle of a coup. That's 75% of global production. So when the world gets twitchy about OPEC, I mean, Kazakhstan is essentially the OPEC of uranium. So one country is the equivalent of OPEC. So, as I said, I go back to the energy crisis, the weaponization of energy and commodities that we saw. It obviously was a bit of a wake-up call and a bit of a scare in terms of what happens to energy systems when critical supply chains get disrupted. And I think that's the big challenge here. So primary production of uranium, obviously highly concentrated in a few countries. You've got the number one producer in Kazakhstan, has this unfortunate position of being sandwiched in between two superpowers, China on the east, Russia on the, kind of north. And guess what? They want a lot of their uranium. So the big question is going to be how much of their production that they're planning to increase, how much of that is even going to be available to flow to other countries? It's a big question mark. So it's very geopolitically, I'd say, charged. And I haven't even got into some of the challenges with, Russia's very dominant positions in the conversion and the enrichment steps of the fuel cycle. We've essentially offshored, between 30 and 40% of those two parts of the fuel chain to Russia over the last 30 years because they've been very, low cost, reliable producers. So now you've got, obviously the United States with 15 different bills working through the House, which many of them are to reshore or nearshore or friendshore a lot of this nuclear fuel supply chain. And utilities have been given a warning that, by 2028, you need to basically wean off of Russian suppliers. And that's the big challenge right now for the industry. And it's starting to move. We've had a number of different facilities that do conversion and enrichment announce expansions and restarts. That's really healthy. But we're talking about, a 2, 3, 4, even maybe 5-year kind of timeline before a lot of this capacity is even there so that this transition away from Russia can happen. So there are a lot of moving parts right now in the fuel cycle. Again, this is changing the psychology of the fuel buyers at the nuclear power stations because this era of complacency, I'm going to use that again, is behind us. This era of destocking is behind us. They need to think very differently about security of supply and how reliable some of these producers and countries are going to be. Again, you can't make decisions with 1 or 2 year timelines. You're often buying uranium with 5 to 10 or even 12-year delivery windows. And you're kind of asking yourself, well, what could happen with that company or that country in 10 years from now? It's impossible to predict. So diversity of supply, diversity of origin, and security of supply, I think, are really driving this, shift back to replacement rate and hopefully beyond contracting, which is really driving the price. I mean, Cuppy said it. I mean, we've purchased 3.5 million pounds of uranium this year. That's nothing. It's a very small percentage of the spot market. It's obviously a much smaller percentage of the term market, which is already through 150 million pounds this year. So it's the utilities that have really, I'd say, changed their attitudes and are now increasingly focused on security of supply and are out trying to, find pounds from reliable, secure places.
Great. That's helpful. Now, before we close it off, I really just wanted to ask you. So I noticed, you have the physical uranium trust, but you also have a suite of uranium miner ETFs. Could you just give us a quick overview of those funds and the exposure you believe they provide versus simply owning the physical uranium?
Yeah, sure. So, a lot of institutions like Cuppy obviously want to just play the spot market in terms of the commodity price, and they don't want to take the operating risks and geopolitical risks and whatnot of the miners. But, historically, when you look at past bull markets, the miners obviously can provide a lot of torque in terms of performance relative to the spot price. And that's just because of operating leverage and optionality can provide that extra return. So we also have two complementary products to Sprott, which are the Sprott Uranium Miners ETF, that's ticker URNM. And then earlier this year, we designed a companion fund, which is the Junior Uranium Miners, and that is ticker URNJ. And they're really designed to give you a broad exposure to the sector. I'll start with URNM. It gives you exposure to the two biggest producers, which are obviously Cameco and Kazatomprom. The next tier of producers, these are kind of the kind of mid-tier producers and producers that are basically turning mines back on. And then a whole host of smaller, development and exploration companies. And finally, I shouldn't forget, it gives you an actual allocation to spot. So you get some physical uranium within that holding. It's the fund is a little over $1.5 billion. And it's been a popular choice for investors that just want to play the kind of broad spectrum of equities. A lot of investors don't want to pick, okay, which of these 30 or 40 companies do I think is going to be the winner? Even in a bull market, you're going to get winners and losers. So I think the reason why ETFs have been so popular is they just give you this kind of basket exposure. And these indexes obviously rebalance every 6 months. So names come and go and they get reweighted. And so it's a convenient, low-cost way to get exposure to the sector. The junior fund is really, take out the big producers, take out the physical uranium vehicles, and you get all of the kind of smaller producers and next generation of developers. So, you would think it's going to be more volatile, but in a bull market, theoretically it should outperform. So two very popular vehicles. And I would just maybe add one additional comment. What we've seen this year is actually a rotation back to the uranium mining equities after a period of kind of lagging the spot market. And I think this is a really healthy sign. And just to give you guys some color, Spot this year has raised about $265 million. But our two uranium mining ETFs, as well as a clone of one of them that is in Europe, have raised just over 600 million. So we're actually seeing the little funds kind of outperform the big flagship fund. And I think that's just a function of this commodity prices finally giving a real big boost to the miners, helping them get back to production and to actually raise capital for the projects. And I think it's also a reflection that risk appetite is returning, because it clearly was very lousy over the summer as people were kind of washed out and frustrated. So I would say we've definitely seen this pick up in risk appetite across the uranium sector that's being played out in flows coming into the uranium mining ETFs.
Great.
John, always a pleasure. So much information, so much insight. John, we're going to see you in a little bit. John, you can do the whole commodity spectrum, but we got John back for Battery Metals One-on-One. John, thank you so much for all the insights. Thank you. We're going to keep the train going, guys. We're going to keep it going. Uranium One-on-One keeps going. Stay tuned. We got a very unique company on deck.
We're bringing the operators now. All right, welcome back to Uranium One-on-One. As we said, the train's rolling, no breaks, no sleep. We got Corey Diaz. He's CEO and founder of Anfield Energy. They're an operator. Welcome, Corey.
Morning, guys.
Good morning.
Now, Corey, can you just start us off by explaining Anfield's what you call it's a hub and spoke model in simple language? What does that basically mean?
Well, sure. Like it's our production strategy is based on, think of a bicycle tire or a bicycle wheel. We've got a spoke at the center, and that in our model is represented by the Shooter and Canyon Mill, one of only three constructed, licensed, permitted conventional uranium mills in the U.S. And the spokes are represented by our mines. So, for example, we have the West Slope properties. We've got Slick Rock. We've got Velvet Wood, and those would serve to feed our hub, which would be Shootering.
Great, that's helpful. Now, what's stuck out to me is that you own one of only 3 permitted uranium mills in the U.S. And when I looked at it, there are 3 permitted, but there's one that's not even close to talking about restarting. So there really is just you and someone else. Now, what is the opportunity that you think owning your own mill provides versus just trying to be a producer?
Well, look, if you're going to produce, you need a mill, right? You need something through which to process. So that's core to have some kind of processing facility available to you in order to produce uranium. So from our perspective, having one of only 3 is hugely advantageous vis-a-vis some of our peers who have mines but no processing facility. So I think it's important to remember that the cost and the time frame to build a processing facility, it could be quite long and expensive. So we've moved past that stage. We're just refurbishing a mill. That's going to take about 2 years to do, and the cost to refurbish the mill is much lower than trying to build something new. Which, something equivalent to our mill, 750 tons per day, would cost over $200 million, and certainly would probably take somewhere between 6 and 8 years from concept to construction. So we think that we're in a great position to get restarted in the current cycle.
Now, we ourselves have been doing a lot of work lately looking at the potential of a uranium mill bottleneck if production picks up in the U.S. and North America. I just wanted to get your opinion because it looks like on the conversion side, which is another part of the fuel cycle, the one conversion facility in North America is effectively sold out for the next few years. What do you think is the potential that if supply starts picking up in the U.S., we don't have enough mill capacity if that does happen? I just wanted to get your opinion on it.
Yeah, look, the U.S. has the largest installed base of reactors in the world, and requires close to 50 million pounds of uranium per year. Even if you turn on all of the producers today, all of the uranium producers today couldn't meet 50 million pounds. So there will be a time when we'll be required to continue to build more processing. But it takes time, as I mentioned, time and money. And, so we'll still be dependent on pounds from outside of the U.S., probably Cameco or other producers. But certainly I think the trend now is to find a way to get more production within the U.S. itself. So you can see that obviously we've got players like Energy Fuels, UEC, Your Energy, who have capacity available now to produce. And then you're going to be looking at the next ones like ourselves. Encore is close to producing again. But once again, those, we're talking about 20 million pounds of capacity when you're looking for 50 million pounds of demand. So there certainly will be more build out required. But those who have the advantage of producing now, are certainly going to be in good stead when it comes to, providing pounds to utilities.
Yeah, it definitely seems like there's a big opportunity. If this reshoring to the West does happen, the current industry is not prepared to supply that. And that's really the opportunity.
Correct. Yeah.
Now, I just want to talk specifically about your Shooter and Canyon mill. So what are the remaining permitting milestones that you need to go through to bring the mill from care and maintenance to operational status? And is there one key milestone that we should be watching for?
Yeah, I think importantly, so, the mill currently has a license, radioactive material license. There are 3 in the U.S. Actually, there are 4, one held by Energy Solutions, but 3 held by existing mills. We mentioned it before. So the Sweetwater Mill, the White Mesa Mill, our mill have radioactive material licenses. The Sweetwater Mill is actually going to be shut down, it's likely. So that license is likely to go away. So there'll be there will be one less license. So our license is, allows us, we're on care and maintenance at the moment. So our plan is to move that license from its current care and maintenance status to operational. And so we have to apply to the state of Utah in order to get the license moved from one status to the other. There's an application that's required, and that application will be submitted to the state in early 2024. So that'll be a significant milestone for us. And we believe that it'll take about 12 months for review, during which time we'll start some refurbishment work at the mill. We expect that the mill reconstruction will take, or refurbishment will take, roughly 12 months. So we're thinking within 24 months, we'll be ready for production to restart at the mill.
Great, that's exciting. So just wanted to wrap things up with what is kind of the next funding milestone we should look for from the company as you move the mill restart forward? Are you looking at a bankable feasibility study, or for people who don't know in the industry how these reports go, kind of what's the next step for you that you're moving towards?
Sure. So we've got a PEA out already. So a preliminary economic assessment was put out earlier this year. What we're likely to do is update that PEA with some PFS level numbers that have been provided to us by PSC. There's a lot of acronyms. So PSC is Precision Systems Engineering, an engineering firm that's working with us to determine exactly what needs to be replaced at the mill, what we can keep at the mill, the costs to buy these new pieces of equipment, and the time frame within which to acquire those pieces. So the accuracy of those numbers will be included as part of our updated PEA. We're also looking at expanding the mill from its current 750 tons per day to about 1,000 tons per day in order to increase production. So currently in the PEA, our peak year is about 1.6 million pounds of production. We aim to increase that, and we're looking at kind of 2.5 to 3 million pounds per year of capacity at the mill. And that'll come as a result of obviously the expansion of the production capacity, but we also have mines available to us. The current PEA only includes Slick Rock and Velvet Wood. We have West Slope, which is consists of 9 mines out in Colorado, and a few other projects that we can bring on even earlier if we expand capacity. So we'll see an uptick in our NPV. We'll see an uptick in our throughput. So we're pretty excited about the prospect of increasing production capacity.
And Corey, could you remind everyone the MPV?
Yeah, so the MPV from the PEA is about $238 million. We use the $70 uranium price. So given where the market is today, we'd expect to see an improvement in terms of the valuation, as we go forward here. So if we're looking at production in, call it 24 months, we'd expect to see the uranium price, probably in triple digits by that time. So that'll reflect quite nicely in our updated NPV.
Yeah, and so and that really is that's the excitement here. Is it's just with respect to like the MPVs, with regards to your project and just where your market cap sits right now. It's just a exciting time. The hub and spoke. It's Corey. Is anyone else that doing following that kind of model right now, or just it's very unique?
Yeah, I mean there are others who've discussed it. I think from our perspective, we're highlighting how we can get there. We do have a mill that's constructed. We do have mines which have mined in the past, produced in the past. So we know that there is actual data in place that shows that this is something that could be successful. But I also have to note that our NPV related to the PEA does not include West Slope, and West Slope has significant pounds. So the NPV can also grow from not only an uptick in the uranium price, but also through capacity and additional mines being put online and put into production sooner.
Great. Well, Corey, that was a great conversation. You guys have a unique model. It's always nice to have one of 2 permits for anything.
Yeah.
So that's exciting. We'll be watching as you develop the asset closely. So thanks for stopping by Uranium One-on-One.
All right. Thanks for having me.
Thank you, Corey.
All right, everyone, Uranium One-on-One, don't go anywhere. Next, we have a company that's been doing some big exploration. They've had a lot of success exploring for uranium. Very well-respected geologists coming up next, so don't go anywhere. Welcome back.
All right, guys. Uranium 101, we're back. We got Rebecca Hunter from Forum Energy Metals. Rebecca, thank you so much for joining us.
Yeah, thanks for having me. I'm pretty
Great.
excited.
And before we kick off, I know there's a bunch of you guys on YouTube. Give us that thumbs up. Let the world know Rebecca's in the house. And if you're on Twitter, give it the retweet. You know what's going to happen, man. There's hats to give away. Rebecca, I got to throw you a hat too. Yeah. You pick. You tell us the one you want.
You got to power up Rebecca. She's not going to give us the insights without the likes.
Yeah,
exactly.
So
help us out. So Rebecca, so you have a pretty impressive track record finding high-grade uranium in Canada, kind of second to none. Can you walk us through your history in the industry just so people know?
Okay. Well, I mean, I started this working in uranium about 2005, but very junior. I just kind of came out of a master's program and started with Cameco, and so I really had an opportunity to kind of delve in at a very junior level. At that time, Cameco was kind of exploring all over the world, so I was kind of helping them kind of assess kind of uranium districts in more than just Canada, so kind of Australia and South America, Argentina, stuff like that, as well as the Canada's Arctic. And so basically that's kind of where I started. And then early on, I ended up in the Thelon, working up there, and fell in love with the tundra, fell in love with the Arctic, and basically moved that project from very grassroots, like just moose pasture, to discoveries within a very short amount of time, and then the rest is history.
Now, could I ask, how does your experience with Cameco and then in your PhD studies translate to the work you're doing with Forum, would you say?
I think the real key thing that I had the opportunity to do is take a very systematic approach to exploration. So Cameco, of course, they're not a junior, obviously. And so you have a bit more stability in your budgets and whatnot. So you have that ability to work an exploration project from very, baseline routes where you get to just get on the ground. Like in the Thelon, for instance, I've walked hundreds of kilometers, sampled hundreds of rocks, and you really basically get the ability to really look at the geology from a very, from the very bottom up. And then do very systematic geophysics and really understand your area, and then apply that to drilling. And so then you have that ability to have, the ability to drill your best targets, essentially. And then with the PhD, that was just a continuation of that. So, when we were in the thick of it, we did as good of, kind of geological work as we could, but it's fast paced, you're learning a lot. So when I was able to do my PhD, I got to really look at that geology in much more detail to really figure out the mineralization that we found, so that, I could take that for Forum and expand on that. And basically now we can just chase up these mineralized zones with a really good knowledge of how to do that best.
Now, I wanted to ask, what are the geological analogs, that's lookalikes in simple English, that you're using as you explore the Thelon property?
Yeah, I mean, as far as the Athabasca is concerned, we look at very similar type of, I guess, geological models and whatnot. And so, we're chasing up those big basins, we're chasing up fault zones, basically in the simplest terms, when we're looking for these types of deposits, we're looking for, evidence of alteration, which is kind of the transport. It's like the source transport trap kind of model, in a very simple term. But more importantly, we're looking for the transports. We're looking for that kind of alteration systems. We're looking for clays. We're looking for that alteration, etc. And then we're also looking for the trap. And so, we're looking for fault zones, areas where that uranium is going to come out and precipitate in hopefully big, enormous pods of mineralization.
Got it. That's very helpful. So you had recent assays from your 2023 program that came out pretty impressive. Could you give us the highlights? But also, I'm very curious if what you've learned this year at Tatigak has begun answering any of the questions you had from your PhD work.
Yeah, no, exactly. So basically we got into Tadagak this summer. We got the money and we were able to do about 1,000 meters of drilling. And so, yeah, our first results into there was at 2% over 11, which we were just ecstatic to get those types of grades and that
That's
type of
great.
thickness. And I guess how that applies to my thesis is when I was doing that work, initially we thought these kind of zones that we initially hit with Cameco were probably more flat lying or more kind of moderately dipping. And what the thesis showed me, like looking at the core photos, looking at the structural data, is that we're most likely looking at these kind of steep subvertical lenses. So that first hole that we drilled in an area that we knew at least was likely very much mineralized, but we drilled it at a better angle so that we could kind of just basically validate that hypothesis that I had with my thesis. So that's really what we did there. And then we stepped out and we actually quite aggressively stepped out into an area where we have much less data and only a bit of weak mineralization. So we did that a 200 and 150 meter step out. And that's where we got the 1% over, I think, around 6 and 0.4 over 12. And those are fairly aggressive. And I think I scared Rick a little bit when we did that step out, because, you know, these deposits, although can be very high grade and amazing, they can be tricky and narrow. And so anyways, the fact that we showed that continuity, and that's really what I wanted to do, to get the excitement of the shareholders and future shareholders, was to show that we have a significant zone here. Now we have about 250 meters of continuous high grade mineralization, and now we can chase that up.
Oh, that's exciting. Now, on the go forward plan, I'm wondering what the drill program and timing looks like, and also what's the strategy? Is it resource expansion, exploration? How would you categorize it? And I'm throwing in another one here because I can. Plans for a maiden resource after your drill program next year.
Yeah, so we kind of have a couple things we're trying to do. So obviously Tadagak is the focus, and so we have the trend now that we know that we can follow, and so we basically want to expand what we have. So that 250 meters of mineralization, we want to infill it a bit so that we can, you know, build a resource out of what we know, and then start stepping out to the northeast. So we still have, you know, over 1.3 kilometers of basically a fertile structure that we can chase. And so we want to build resource at Tadagak, and also the rest of that Tadagak anomaly also has subparallel faults that we want to chase. And then we also want to use, you know, so about 75% of that, you know, the budget that we're going to have in 2024, I want to focus on that and build that resource. And then use about 25% of that to keep chasing other areas as well that I feel, you know, have really high potential as well. As far as a maiden resource, I think we're going to need a couple years, depending on what we find at Tadagak, to actually get to that stage. So, you know, maybe if we can get, you know, enough drills up there, you know, end of 2024, we might have a really good idea, but, 2025. But, you know, 2 to 3 years at least to build Tadagak to where we need it.
Got it. I mean, in the industry, is that typical depending on what you find and how much you find, how quickly? Does that determine when you do these resource estimates to some extent?
Yeah, I mean, it depends. Like sometimes you have like a really continuous good mineralization that you can build that tonnage and deposit quickly. But I mean, 3 years, 3 years, that's fast. I think
Yeah.
it usually takes several years to build that to a level that you can actually make a very precise resource.
Got it. Now you've already found some high grade tonnage in the ground, but you're still looking. In your deck, you said you're elephant hunting along the Thelon Fault. Just curious, what is the geological data that gets you the most excited, and when do you plan to drill some of those exploration targets? You said about a quarter of the budget may go to exploration.
Yeah, so I mean, like one of the things about the Thelon is that, again, it's underexplored in general. We found these really great basement deposits, but there's that big potential for those more unconformity contact deposits. And so where the sandstone is still intact. And so you get the really big ore zones in the Athabasca are at that contact between that Proterozoic, what we call that Proterozoic sand, in this case it's the Thelon Basin, and the rocks underneath. And so we understand now through, all the work that's been done in the past, the work that I've done is in my thesis, that we know what kind of structures to target. And so there's this fault to the north called the Thelon Fault, and it has a number of really good gravity geophysical targets. We use gravity in the Thelon because it basically detects density differences, and basically it's a proxy for alteration, and then subsequently a proxy for mineralization. Anyways, we have a number of these really great targets. And so, if we're going to find, to me, right now, if we're going to find one of these really high grade, high tonnage deposits, which I'm confident are just waiting to be found up there, there's no reason why the Thelon shouldn't have these types of deposits. It's going to be there. And so that's why I do want to focus some of our budget to looking for those types of deposits, and because those will be a game changer for that whole district in general.
Well, Dr. Rebecca Hunter, you've been a wealth of knowledge. This is exciting times for Forum Energy Metals. Congrats on all your success, and we'll be watching your exploration closely, obviously. Thanks for being with us.
Yeah, thanks a lot.
Rebecca, thank you.
All right, everybody. Hope you're having fun at Uranium One-on-One. We've gone the gamut like only Grizzle can, right? We got the geologists, we got the investors, we got the guys providing the investment vehicles, like covering it all, but we're only halfway done. So next, we're coming up with another future producer, relatively new to the market. So it'll be interesting to hear from them. That's Energy Fuels coming up.
And nuclear fuels, and we've got we're very excited to have Bill Sheriff joining us.
So we'll be right back. All right, welcome back to Uranium One-on-One. We have a surprise guest. We're lucky enough to have Nuclear Fuels. We have both the CEO and the chairman with us, Mike Collins and William Sheriff. Thank you both for being with us.
Good morning, guys. Thanks for having us.
Thank you.
Now, I just wanted to start things off with Nuclear Fuels is relatively new to the public markets compared to some of the other guys out there. Can you just tell us about the company's strategy, the team, and where your assets are located?
Sure, I'll give you a little background, which will really answer that for you. The company was essentially started with a number of assets that Encore Energy came up with. And these principally are ISR projects that require significant exploration, but have a really great start on them. And the keystone property for the company, or the marquee property, if you will, is the KC project. In fact, Mike and I are both in location here in Buffalo, Wyoming, heading out to the field a bit later, and did some in the field interviews yesterday. But KC is just a phenomenal exploration opportunity. I might add that Encore is strictly dedicated towards production, and that's why they looked for a home for the KC project with a top-notch team, and retained a back-end right. But we put the KC project in. We've also got the Moonshine project in Arizona, which is lined up for the number 2 slot. And then we've also got a couple of other projects, Boot Heel, that had a 43101 under its previous owner, also in Wyoming. So we're strictly dedicated towards in situ exploration here. And, Encore is our biggest shareholder at 19.9%. We do have a couple of board reps on the board, myself included, along with Gene Spearing, who's got a vast experience in the uranium business. The team is augmented at the board level with David Miller, who was Strathmore's chief geologist, many years in the in situ field, working with Pathfinder, Kojima, very well recognized geologist in the field. So, we've really put together a top-notch team here. We've gone out and hired a handful of exploration geologists that are really top-notch uranium geos, and have the largest and I think most promising exploration project in the United States in the in situ field, certainly. We've got at Casey, a very long trend. We came across a database that had not been utilized for many years. Project's seen virtually nothing done on it since shortly right after 3 Mile Island. So for 40 years, it's laid kind of dormant. It's the western half of the Powder River Basin. And once we put that database together, we recognized this is a first-rate project, and we needed a first-rate team to do exploration on it. And basically, the terms are if certain thresholds are met, either 10 million or 15 million pounds at different grades, then Encore can claw back in for 51% interest by paying 2.5 times the exploration expenditures incurred by nuclear fuels to that point, and also carrying them to production, recoverable out of production. But most juniors don't really have a clear-cut path to production, and they're at essentially the mercy of finding enough to sell to another larger company. So the format's a bit unique in that we've got a real road to production.
Great. That's a great overview. Now, I had a question for you, Mike. You founded a Southwestern uranium producer during the last uranium bull market. What would you say were the key lessons learned that you're taking with you to nuclear fuels for this current cycle?
Okay, so in the last cycle, we were focused on conventional production, and we learned very quickly that you either had to have access to the mill or you had to have your own mill. And there's only one conventional mill in the U.S. So you're pretty limited in your options of that. The other thing that we saw as we were pushing on that, we actually managed to get toll milling access to the White Mesa mill, and we also had a mill plan under development of our own. But we were also watching the ISR companies and how quickly and efficiently they were able to take resources to the market, raise money, and also be able to put them into production. So the timelines are so different, and the relevance. Time is money, whatever you're doing, and ISR is just so much more efficient. So that on this cycle became a real focus for me to look for assets that were in the ISR class, the in situ recovery production, and also looking for assets that are in agreement states. Probably talk a bit more about that later.
Yeah, that's very interesting. Now, for people who don't know the geology and the history of uranium in North America, could you just talk about why Wyoming is such a good place to be if you're in the uranium business?
Yeah, so you've got these very large sedimentary basins and a lot of volcanic rocks around, and also some big radioactive intrusive rocks, and they've been shedding uranium into the basins for millions of years, and that's provided the sort of the source material for these concentrated in situ recovery roll front projects that we're looking at. So it's got a scale that we don't see anywhere else other than Texas for this type of mineralization. So it's a really great spot to be.
Oh, that's great. That's helpful. Now I wanted to ask you what's so special about the KC project. We'd love to hear more about the history of this land package.
Yeah, so this was actually developed by a subsidiary of Detroit Edison Electric, and they were really looking for uranium to put into their own reactors. And until you got to 3 Mile Island, there was a grand plan for the vast majority of power in the U.S. to be produced through nuclear reactors. That kind of came to a halt with the drop of uranium prices in the early 80s, and all of that data was lost. But you can see the scale of the package, and really, other than the eastern portion, the eastern block, and the southeast side of that yellow map, that was the core area that they were focused on. There's over 110 miles of roll front that they mapped out. There's I think close to, is it 2 2 million pounds historic?
Yes,
about 2 million pounds historic resources in there. The trend is over 33 miles long as you go around the curve on the western side of the basin. And you look at the other producing assets out there, and you can fit 2 or 3 of them into it quite easily. The scale of it is there's nothing that compares to it in exploration right now.
Great. So you just started a fully funded 200-hole drill program. Now, are all 200 holes targeting the same zone or formation? Kind of what's the goal there with the program?
They are now. We've got a sort of cornerstone target area, the Saddle Historic Resource that's in the Upper Wasatch, the Upper Formation. But we have 2 additional formations below that, the Fort Union and the Lance. And as you can see, we're kind of tipped up on the western side of the basin. So we're able to drill more than one formation actually with the same drill hole. And that's a real great advantage. If you look off to the eastern side, the second and third, the Fort Union and the Lance formations are too deep to get in the same drill hole sections, and it's just not economic. But so we have the opportunity of hitting probably 2 out of the 3 in any given drill hole that we're drilling. So and we've had actually some really good success there in the current drill program at Saddle, hitting both the lower Wasatch and the upper Fort Union mineralized zones. So yeah, we're pretty excited about that.
Great. So most of the discoveries and information you have is shallower, and you're trying to go deeper. You think there's a lot of opportunity down there?
Yeah. So it's kind of interesting. These guys, when they were doing the exploration in the 70s and 80s, had a very long-term plan. They were really outlining the bones of the district. We're going in and we're actually following those roll fronts that they've mapped, and we're able to pick them off and look deeper and do more dense drilling. And so we've gone from generative exploration, which is what they were doing, to doing actual resource targeting, I guess, at this point, and able again to drill a little deeper than they thought was viable at the time, probably too. So
great. Now, I'm curious, when do you expect your next batch of drill results, and when do you think this program that you're doing right now will be completed?
Well, we've actually put some numbers out this morning, which are pretty solid, both in the Wasatch and in the Upper Fort Union. We're trying to get a release out of every week. We're using gamma logging to produce indicated uranium assays as opposed to doing chemical assays. So we really know the same day what the assays are coming off of the drill holes that we have, as opposed to a lot of places where you're doing chemical assays. So you've got to cut core, you got to ship it, send it to the lab. The lab tells you all sorts of sweet things that you're going to see your results in 3 weeks, and maybe 4 months later you're seeing some numbers, and that's just such a painful and ugly thing. So yeah, we've got the drills continuing to turn right now. We'll be drilling into December and really trying to get a release out every week. We got a lot going on, but we'll try to put our head around it and put a package of results together every week.
Great. So you got a lot of information coming over the next month or so.
Yep.
Okay. Now, for investors who don't know Wyoming's geology that well, could you tell us just in general, what's a bonanza grade, a very good grade, and say an average grade in the basin?
So bonanza is a little hard to nail down in ISR targets, but sort of exceptional grades would be over 0.2% U3O8. A really good grade, I think we would be looking at sort of 0.1. If you're looking for production grades, the average is probably about 0.07, and we're actually seeing assets that are licensed and going into production shortly here at 0.045, that kind of territory. So if you look at the numbers we're releasing, we're doing really well in terms of that. This is
great.
It's got pretty solid concentration and grade.
That's very, very helpful. Now, maybe I could just end things off with kind of, as you look at your resource bogey that you're trying to hit, that you think we can commercialize this. Is it the 15 million pound Encore milestone? Is that the bogey? Or is there another milestone you're targeting longer term, just like big picture?
Yeah, so the sort of the economic model that most ISR companies are looking at is they want to see 10 million pounds. This is sort of district scale, and Encore is looking for larger things. So we're targeting 15 million pounds as that back end right. That's the agreement that we have with Encore. But fundamentally, I think that's the start for this project. It's not the finish. There's a lot more there. And if you look at the company as a whole, you look at Moonshine, you look at Boot Heel, we've got a lot of other historic resources that are open for expansion, some pretty solid grades and really great opportunities.
Great. I mean, thank you guys for all the information. This has been a great conversation. Everyone you've been hearing from Nuclear Fuels, we've talked to Mike Collins and William Sheriff. They're CEO and chairman of Nuclear Fuels. Thanks for stopping by, guys.
Guys, thank you.
Thanks so much for having us.
Yeah, thank you.
All right, Uranium one-on-one. We need more likes. The hats are being given out. They're being thrown across the internet to you.
Yeah, listen, you get the red, you get the blue. Listen, we've got the lineup is stacked. The train keeps going. If you're on Twitter, hit the retweet. That's what happens. I'm gonna pick a bunch of people, get the hats out to you guys. And if you're on YouTube, we're interacting, we're talking, we're throwing the hats out. Please keep the comments coming.
Drop a comment on why you want a hat, and we'll enter you in the drawing. There's not that many people. We have a good chance of winning one of these. Actually, it's a really good chance.
In terms of comments, get in there, and then for thumbs up, to throw the thumbs up, let people know. All right, guys.
Coming up next, we got another Wyoming producer. We'll be right back. Everybody, welcome back to Uranium One-on-One. We're excited to talk next with Bruce Lane. He's Executive Director of GTI Energy. Bruce, welcome to Uranium One-on-One.
Hi, Scott. It's great to be with you.
Now, Bruce, start us off by giving our listeners a brief overview of GTI, your footprint, and your current resource.
Yeah, look, GTI's been exploring for uranium in the US for the last few years. We've got one patch of dirt at Green Mountain with 14,000 acres, another bit in the Great Divide, 20,000 acres, and our Lohuma project, which is our lead project in the Powder River, there's 11,000 acres there. So we've got about 2,400 claims, and we're in our third season of drilling.
Great, that's very helpful. Now, you yourself have a long history of putting together uranium deals, I saw. So can you tell us more about your history in the uranium industry?
Yeah, look, I got started back in about 2005 or 6. My first involvement was with a company called Stonehenge Metals, which had a South Korean uranium project. We recapitalized the company at 1.5 cents. When I left and I kind of handed over to somebody to run that company. This was quite a number of years ago. It was 23 cents. And then unfortunately, the next step was a big tidal wave off Japan. And unfortunately, it got Fukushimaed. But I also got involved with a company that had, we listed in the Northern Territory, that had tenements in the Northern Territory called Atom Energy. So we listed that at 30 cents. And I think it went to 70 cents. And unfortunately, it was also part of that cohort that had a problem with a tidal wave and an earthquake in Japan. So, but back then, I saw the response to the market from the market in the sector and how responsive these companies were to investor sentiment. But I was always interested from an energy first principle. The energy density of uranium and nuclear power always made sense to me. So, it's sort of been biding my time to get back involved. And back in 2018, it's pretty clear that the energy transition narrative and the drive to net zero was going to be a big boost for nuclear power. And obviously we're seeing that come through now.
Great. Thanks for that history. Now, GTI just started an ambitious 15,000-foot drill program in Wyoming. So I just wanted to ask you, what are you hoping to accomplish from all 26 holes? And at this stage, what information are you looking to receive from the remaining 42 holes that you have planned for next year?
Yeah, so we have already 850 or 800 odd holes in that project. We bought a database that had 1,700 holes in the early part of this year, and we were able to declare a JORC resource the back end of June of 5.7 million pounds at a production grade of, an average grade of 630 ppm, which we know is production grade, and the district our neighbours are producing at a grade lower than that. So look, we've got a really good start with this project, but we need to verify that database by twinning some holes, and that's obviously a key part of the program, is to then verify, validate that database, and then hopefully upgrade some of it to indicated category. And then we've got some real exploration potential there. We've got an exploration target of an additional sort of 5 to 10 million pounds there at this stage, and that's both a long trend, but also at depth. So these holes, historical holes, are in what we call the Wasatch Formation, and that's a productive formation in the basin with our neighbours. We've got UEC, we've got Cameco, and we've got UR Energy around us. But Cameco, 10 miles to our east, is producing out of the deeper Fort Union Formation, which is below us. And we know there's mineralisation in there, and one of the exploration potentials is to find a good mineralisation at a bit further depth, and so we'll be testing that as well. We won't want to spend the next layer of money until we've done this I guess in-ground research, if you like, and what we'll do then is use that to plan that bigger program for next season, and that would then help move us along towards a PEA, like some sort of pre-feasibility, I guess under NI 43-101. It's a preliminary economic assessment, a study. So look, we've got a lot to achieve from this program. I guess it's kind of modest in the scheme of things, but it's a sensible next step before we go spending the next layer of capital on drilling.
Now, just to follow up on that, I'm curious what part of the property you're most excited to drill out.
For me, look, I'm really excited about the depth potential. I mean, we know there's mineralisation along trend. It's pretty clear, and we've got geophysics that we flew over the project earlier this year that shows us where the surface radiometrics are singing, and that's generally for the shallower mineralisation. But we know it's there at depth, and really, so I want to see the potential to the north and the east and at depth. And look, if we know that a £10 million project in this part of the world is highly valuable. UR Energy is moving on to develop their Shirley Basin project, and that's £8.8 million. So as a satellite ISR project, so we know if we can push on towards that 10 million and then beyond, we're really getting somewhere with that particular project.
Now, you talked about some of your partners, so I wanted to move on to that. Your Low Herma in situ project is near at least 6 other processing plants. Now, did you point this out in your recent press release because there's a potential to piggyback off of these processing assets, or was it more just to show the potential of the rocks in your area?
Yeah, look, I guess in the first instance, we just want to show that we can get these, we think we've got a high degree of confidence that we can get these things permitted and that they can become production assets. It's not a new thing for Wyoming. They've been doing in situ recovery there since the 70s. It's the US's largest uranium state. That they really do. It's a self-sanctioning state for uranium, so they don't have to go to the federal government to get stuff permitted for exploration and extraction. So we wanted to show that there was real potential to commercialize these deposits. Now, of course, there are lots of production plants around, and it might be a possibility later to work with one of our neighbours, either for them to process resin or for them to joint venture with us. But that's probably getting ahead of ourselves, and we've seen lots of companies talk about the potential of doing that with their neighbours, and then Mark Chalmers famously with the Blanding mill down in Utah went out of his way to point out to all the juniors that were saying they were going to process their uranium through his mill that none of them were going to have a deal, and that he gave the deal to Consolidated. So look, we're not going to put ourselves in a position where we are going to sort of front run that conversation. We need to put some clear metric and some value around the asset in the ground, and then there'll be a conversation if that's the appropriate thing later.
Now, I wanted to move on to your resource for a minute. So GTI has over 7 million pounds of uranium as an inferred resource in Wyoming. I'm curious, what's the critical mass number you want to hit that would tell you the economics make sense to move towards development and production?
Yeah, look, I kind of touched on this in the last answer, didn't I? I think we know that Shirley Basin, UR Energy's Shirley Basin, they're developing that as an 8.8 million pound project. Azaga had a project which they sold to Encore in the Gas Hills, which is around that sort of 6 or 7 million pound mark. And look, if you listen to Bill Sheriff at Energy Fuels at Encore with the nuclear fuels project, they say, look, if you can get to around that 10 million pound mark, then Encore is going to be interested. So we think it's a good rule of thumb to say, look, if we can get close to 10 million pounds, that's £1 million a year operation over 10 years or thereabouts. Could be more, could be less. Depends on the grade, depends on the thickness, and all those good things. But we think that we can wrap a PEA around that, and the capex is reasonably modest. Depending on how you capitalise the bore field, we think it can be, a $75 million, $50 to $75 million investment exercise potentially. But that's really spitballing, early days, obviously very forward-looking, unsubstantiated. So please, not investment advice, do your own research, all that good stuff.
Yeah, but it's still obviously very helpful to have back of the envelope numbers to work.
That's our entry point into real commercial possibilities to build a central processing plant. That really gets you in the game, we believe.
Now, I just wanted to ask you, why in situ over conventional mining? In your view, is in situ really the future of uranium production in America?
Well, look, it's about half the world's uranium production now, and I guess a big part of that is driven by the fact that the Kazakhs produce via in situ, and they're supply about 40% of the world's uranium. So I think it's a good way of mining if you've got the right geology and you've got good grade thickness numbers. It's very simple where we are with an alkaline leach. We may not get the high recoveries, but it's a very simple metallurgical process. And as long as there's no polluting of the groundwater, then you're not shifting all those tons to get out the ore. It just sits in the ground. You put the water in with the lixiviant, and it does its work in that slow kinetic leach. So it's a bit of a no-brainer from an ESG environmental impact point of view. It's very attractive, and the capex is low. So for the right deposits, I think it's a really good way to mine uranium. But if you've got 5% uranium across a couple of meters in the Athabasca Basin, I wouldn't be saying that's a bad idea. So, it's interesting to see Denison using ISR. I think that's a really interesting development. And, let's hope they can make that work, because it is a very environmentally friendly way of mining, as long as you take care of the groundwater.
Now, just to end us off, Bruce, I'm curious, what are the upcoming milestones we should be watching for from GTI?
Yeah, look, clearly the drilling, hopefully we can get it done this year. We're always at risk of the snow coming early in Wyoming and shutting us out. But if we can get that completed, and then we'll have some results off the back of that, then there'll be the drill targeting and the permitting for the Green Mountain project for next year. So those are the near-term things that we've got to look forward to.
All right, everyone. You've been hearing from Bruce Lane. He's Executive Director of GTI Energy. Bruce, thanks for being at Uranium One-on-One.
Great. Thanks for having me, Scott. It was great to talk.
All right, everyone. That's all she wrote for this segment, but don't go anywhere, because who do we have coming up next?
We got the green chicken, none other than Doomberg.
The irradiated chicken is up next. Don't go anywhere. We'll be right back. Uranium One-on-One.
All right, before we go to the one, the only Doomberg, we got to thank who's made all this happen, the partners that bring this together. Let's roll up the credits, the good people.
All right, we got Praetorian Capital, Kings of Inflection Investing, getting there first. Also, you have GNR Investors. They're the premier natural resource investors. Check them out. We got to talk also Doomberg, #1 finance newsletter on Substack, going 200,000 subscribers strong. And then lastly, Grizzle Research and Quant on Substack. We combine quant and fundamental research to identify mispriced opportunities with compelling upside. And last but not least, we got Sprott Asset Management. We already heard from them. Great insights. Leading global asset manager in precious and energy transition metals. Now it's time to hear from the green chicken himself. Let's do it.
Hey, we got Doomberg here. Doomberg, how are you?
Hey guys, how you guys doing? Doing great myself over here. I hope I'm just listening to this fantastic conference and a real honor to be part of it.
Oh, thank you, Doomberg.
Doomberg.
You know, Doomberg's been there since day one, and we've cherished the partnerships through time, and now Doomberg, you're sitting as the #1 finance Substack. Congrats, man.
Hey, congrats to you guys as well. It's always fun to grow together. Watching what you guys have done has been really amazing, and putting together a spectacular lineup like this. We were joking off air that it always gives me a good laugh when I see this flyer of all these serious and really outstanding people, and then there's this green chicken in the middle of it, and so it cracks me up every time. But I did want to say how much I appreciate speaking with you guys, and how much I've been looking forward to this session we're going to have today.
Doomberg, you're a perfect example of what we believe is the future of Grizzle. Bringing top-level insights. You don't need to always just be all buttoned up to bring the insights. We're proving that. You're proving that. That's what Uranium One-on-One's all about.
Buttoned up. He's got a coop. He's sitting in a coop.
Yeah.
Oh, man. Doomberg, thank you. And so, guys, if you don't know, you should know. Doomberg, #1 Substack. A lot of the context we're talking here, the Doomberg's had great posts that are in the Doomberg Substack. That's doomberg.substack.com. Doomberg, to kick it off with the current state of the energy landscape. Last year, we averted an energy crisis. Are politicians waking up to the importance of nuclear as a part of the solution going forward? And maybe you can kind of give a backdrop of how the table is set right now. Are we still teetering close to another crisis? Clearly, we're not out of the woods.
We're almost out of the woods. I think we have to get through one more winter in Europe. I saw an article, I think it was posted in Reuters yesterday, with the title, "The Energy Crisis is Over." And I think that's probably true if you define crisis as, what we saw last year with $100 per million BTU natural gas, which is just a crazy price. If you look across the world today, coal is kind of one of our leading indicators of crisis, and it's priced in the low 120s, I think, last I checked. That's a pretty reasonable number for coal's utility in today's society. As it pertains to nuclear in general, I think there's something really important going on, which I'm sure others have commented on. But I want to point you guys to a recent development in the state of Michigan, of all places, where the governor just signed into law what many on the conservative side are declaring to be, a replica of what Germany has done, or following in Europe's footstep. Because they read the headline and it says, 100% clean energy by 2040. If you actually read the bill, nuclear is defined as clean. And I think that's the big sea change coming out of the crisis. In addition to nuclear, natural gas with carbon capture is also defined as clean, much to the chagrin of environmentalists who are also upset with the law. So I think the big lesson from the energy crisis that has since waned is that you really can't decarbonize without nuclear power. And serious environmentalists who are genuinely concerned about carbon, whether or not you think that's a crisis is your own right to believe. But the serious progressive environmentalists are coming to grips with the fact that there is no path to decarbonization that doesn't run straight through nuclear power. And I would point to the latest bill passed in the state of Michigan as just the latest piece of evidence for the momentum behind the sector.
That is really incredible. And be it decarbonization or departiculate matter. When you think about power, and you've talked about at great lengths with respect to the energy density ladder, really, we were leaving out this clear opportunity, and now feels like we've recoupled on that.
Yeah, and I would point to another milestone. Again, investing is all about looking for milestones and reacting to the news before the market digests it, right? So we just wrote a piece about hydrogen, and there's a big fight going on right now about what constitutes clean hydrogen, and the U.S. Department of Treasury is about to release a set of rules around that, and I would keep a close eye on how they define, hydrogen derived from splitting water with nuclear power. Environmentalists are trying to argue that the lifetime carbon intensity of dealing with nuclear waste should disqualify nuclear energy from receiving the hydrogen production tax credit. That is the big fight, these so-called 45V tax credits. Keep a close eye on whether at the sort of the federal level, Biden continues down the road of being pro-nuclear. I think he will, because there's this talk about an effort at COP28 to sign up a bunch of countries to make clean nuclear energy a key component of the battle against climate change, as they would call it. And if we see that at the federal level, that coincides with what Governor Whitmer just signed in Michigan, and she has, of course, national ambitions. And so I don't think that would have been included in the bill in Michigan if that wasn't a hint as to what's to come, with this 45V tax credit. So almost everywhere we look, we see a reconciliation with physics. There's still battles to be fought, and there's a lot of momentum in this space, which could give people pause, because at a time of euphoria, maybe you should be, as our friend Tony Greer would say, participating and hedging a little bit at $80 a pound up from where we were. But it can't be denied that at the sector level, one of the key learnings from the energy crisis is that we just can't get there without nuclear. And so if we really insist on going there, we got to pull the uranium lever.
Doomberg, you made a great point on radical environmentalists versus serious environmentalists. I like the way you framed that up. And you had a great piece with respect to the design flaw in multi-party parliamentary systems, particularly Germany and Canada. Maybe you could expand on that, because it really comes down to these unserious environmentalists that are causing that are not allowing us to progress forward to where the serious environmentalists want to go.
Yeah, absolutely. So one of the flaws in parliamentary systems where you have more than two parties is if no party gets a majority of the vote, then some small minority party can wield disproportionate power. And the opening story for that piece was the NDP in Canada, of course, a very minor party at the national level, but is basically able to control disproportionately Trudeau's government, because they're always, one vote of no confidence away from an election. But the greatest impact of that flaw has been in Germany, where the Greens have never really captured more than single-digit teens % of seats in the German parliament, the equivalent of the German parliament, and yet they have been able to completely deconstruct the nuclear energy sector in Germany. And we see what's happened as a consequence. Now, people will say, Angela Merkel was the one who did it, but she co-opted the Green agenda to build her coalition. And it's only because you have this flaw in multi-party parliamentary systems where if the leading party only gets a plurality of the vote, they have to cut a deal, and typically they have to cut a deal with the more extreme side. And what you end up with is a ruling government that makes decisions that are out of step with the great middle, as we describe the soft left and the soft right, which makes up probably 70% of the electorate. And so we see that often, and frankly, we're about to see the reverse in a lot of these countries. I think there's an ascending wave of right-wing reactionary politicians being elected to parliaments in much greater numbers across Europe and in the West, and that works both ways. They're going to be members of coalition governments, and they're going to extract their pound of flesh too. And so I've been trying to warn our friends on the progressive environmental left that the path function matters. How you get from here to where you want to go can actually cause you to fail if you use the wrong tactics. And Germany is a fine example of that. Now, for the rest of the world, Germany is a great contra. Don't do what they did. and we're going to see the consequences of that. But for the rest of the world, which is luckily for uranium bulls, a far larger part of the addressable market, I think that cautionary tale is manifesting itself here. Look, you have Gavin Newsom working hard to save Diablo Canyon. You have Whitner defining nuclear as clean and trying to save Palisades. And these are people that have national ambitions. So I think, I think we should look for things we can agree with across the political spectrum. And if everybody could just agree that the anti-nuclear Malthusian extremists should have far less power in our society, then that's a win for everybody.
Yeah. No, very well put. Now, another great piece you had put out, and now it's a levelized cost of electricity, and this has been a tool that has handicapped nuclear versus solar and wind. You wrote a great piece debunking the math. Could you walk us through just how you think about this?
Levelized cost of electricity is, in our view, tantamount to academic fraud. It purports to compare the various energy sources in a unified way, but it's basically an exercise in goal seek. The entire point of the exercise is to make wind and solar look good at the expense of traditional sources of energy, including nuclear. We laid out in that piece, we've been referring to it as such for during many pieces, and our subscribers have been asking us to write a holistic assessment of it, so that they could just point to that, as we joked in the piece, just in time for the holiday party circuit, when people are telling you about how cheap and glowing wind and solar will be. So the five main flaws of levelized cost of electricity are: it fails to account for intermittency. It just assumes that the grid will accept all electricity when produced. It totally flips supply demand. It assumes demand will be there based on the supply provided. It ignores value deflation, which is this really emerging phenomenon that occurs when you reach a critical mass of wind, let's say, in a grid, or solar in a grid. They all are competing for the same increment of demand when the sun is shining. And so adding more solar to a grid when it's saturated actually drives electricity prices negative just when the sun is shining, and then drives electricity prices to enormous heights when the sun isn't shining, because you have too much solar and you can't meet demand and insufficient storage. So it also ignores system costs. By its nature, we want to extract wind and solar because of their high land use requirements, which derive from their low energy densities. You have to go to places where people don't live to generate that capacity, which is why you're seeing all these fights in rural America who don't want these wind turbines or these massive solar farms blighting, their local environment. The system cost of transmitting that electricity from faraway places to population centers where it's needed is ignored in levelized cost electricity. It's limited to new builds. So if the goal is to replace existing fully depreciated natural gas, coal, and nuclear power plants with new builds of solar and wind, that's not a like-for-like comparison, because we have these plants that exist. We can keep them running for basically variable cost. The fixed cost has been paid for and fully accounted for in all of the tax documents and so on. And the last point, which is the most important, it is open to manipulation. It is extremely complex calculations to make, highly dependent on scientific discretion, and the scientific field is no less immune to groupthink and societal pressures to come up with the quote right answer than any other sector. And because it is highly technical, it is very difficult for non-scientific politicians to understand when they're being played. And so for those five reasons, intermittency, value deflation, system costs, comparing new versus depreciated, and the propensity for manipulation, anybody using levelized cost of electricity to compare fuel sources is either a victim of propaganda or a knowing purveyor of it.
Could I confirm, Doomberg, that the cost of batteries is not included in that calculation? I think your first example confirms that.
Basically, yeah. So if you look, to be fair to Lazard, who is the firm behind the birth of this highly defective metric, they disclose all of these things in the footnotes. But that doesn't stop the New York Times and the Washington Post and the New Yorker magazine from abusing that metric and just flippantly saying that wind and solar are the cheapest forms of energy. And look, if wind were among the cheapest forms of energy, you wouldn't need to subsidize it to the level it is being subsidized, and somebody somewhere would be making money in the industry. Like, find me somebody in the wind sector who's making money today. And offshore wind in particular is an abomination. But I digress.
Go ahead.
I was just going to say, I don't get the warm and fuzzies when I see all this stuff, because I really do want to get to the bottom of what is the even, economics of renewables. And I see things like there's big utility companies in the Southeast that keep talking about the opportunity from repowering solar panels and repowering the windmills to generate extra cash flow. All well and good for an investor. But when they originally looked at the cost of that windmill, were they saying they were going to spend that cost again to repower it in, say, 8 years? I'm just not sure. So that changes, obviously, the true economics versus what you say is a 30-year windmill, for example. If it's really, we got to replace most of the pieces in 8 years.
Oh, it's even worse than that. As we described in a piece, I think it was called Windbaggery, the IRS incentivized a bunch of owners of wind turbines to replace their blades early, make them a little longer, produce a bit more electricity so they could get the tax credit for a much longer period. And then what you have now is this mountain of blades that are impossible to recycle, very difficult to recycle. Nothing's impossible. Piling up in landfills 8-10 years after the initial installation, just because they're gaming a tax system. And ultimately, the Inflation Reduction Act is going to devolve into an orgy of grift. I mean, let's just call it what it is. There's just no doubt that government needs to partner with industry for such major fundamental capital projects like the front end of our energy production and transmission. But at the same time, that means we are susceptible to the grift and cronyism that has saturated the field. And as we wrote in the piece about hydrogen, the fight over these 45V credits is just the latest example of a brawl to wetting their beak, I guess, to use an appropriate analogy, between the various people at the trough.
Doomberg, this is such a powerful. What you're highlighting here is so powerful, because it really is the bedrock for us to say this is the right path. If you are, if you're in the view that carbon needs to be reduced, or get less particulate matter, that the measuring stick I'm using is all wrong. And to me, it just feels like if once you kind of fix all that, the leader in delivering all of these environmental plus solutions is clearly nuclear. Like, there's not even a number 2 or third best, right?
Yeah, and let's be clear. You don't need to care about carbon for nuclear to be superior, even by, a corrected levelized cost of energy. But the fraud of levelized cost of energy is that it is being used as a supplement to, hey, if you don't worry about carbon, you should still do solar and wind because it's the cheapest.
Yes.
And that's just a lie. It's not true. And it's no coincidence that everywhere in the world where solar and wind have achieved meaningful market penetration, on average, integrated over the total system cost, which is what the consumers pay, prices go up. And if you look at Ontario, where nuclear is supplemented by hydro and a few other minor inputs into the grid, Ontario has a perfectly fine grid. And by the way, 4 generations. Okay, like the upfront cost being paid today. One of the things that we think about a lot here, we haven't yet written it, is we're still riding the investments that Dwight Eisenhower made, right? Nuclear,
right?
The national highway system, like all of these things are fully decapitalized that we get to benefit from here in the U.S. I know you have a global audience, but what are we doing for the next generation? I think we ought to leave the next generation with 3 times as much nuclear power as we have now that will last for 80 to 100 years.
That's a great point, because the amortization period used in a levelized cost for a nuclear plant, you always get extra innings, and a lot of them, versus wind, it's the other way, right?
Yeah, is it less than they
of course,
promised?
Of course, it's like comparing a internal combustion engine car, which with the proper set of wrenches you could keep running for 80 years, with a battery powered vehicle where the battery is, we all know that batteries degrade, right? And if you look at the real data, which insurance is reflecting, these cars are more expensive and the batteries degrade and you have to replace them and so on. And so This is the exact same calculation. Look, our society evolved the way it did for very sound reasons. And when you want to completely rewire society, you better have a pretty darn good reason to do it. And we're a little unconvinced that this is going to happen.
Doomberg, one final question, and it's a little off the nuclear path, but just you nailed this precisely.
Give credit where credit's due here.
You nailed it. When this Russia-Ukraine situation was developing, you correctly identified how ineffective these sanctions would be, and they ultimately turned out to be totally ineffective. We're closing in on 2 years of this war. What policy levers should we use to fix this now? And are politicians waking up to the fact that you correctly identified that we're not going to sanction our way out of this? I'll let you kind of talk to the solution, but to me, it's a no-brainer, and you've been such a great advocate for this.
Look, anybody who has spent 5 minutes in the commodity sector knows that you can't reduce somebody's revenue by trying to sanction their volume, because they're just going to more than make it up on price. These are highly inelastic materials. And we've argued from the beginning, we should want every single molecule of hydrocarbons that Russia can produce into the market as quickly and as friction-free as possible. We should be using our Navy to escort their LNG carriers to get to market as fast as possible, their oil tankers. Bring every molecule to the market that you can. We want to flood the world with supply, which will crash the price, which will then crush his revenue. If your very narrow objective is to reduce Putin's revenue for his war machine, and Putin is a very significant supplier of fossil fuels in the export market, then the only way to reduce his revenue is to radically flood the field with fossil fuels and destroy price. And this works. What the industry is about to overbuild LNG right now. We just released this morning our Doomberg Pro Doom Zoom for November, a detailed 55-minute presentation on the global natural gas market, and we see a glut coming. We're going to write about this for our regular subscribers here soon. If we had flooded the field with energy like we did for the first Gulf War, Putin would have far less money to spend on his military than he has today. We should be escorting his oil and gas into the markets. Every molecule he produces, we should spread to the world, because that will dampen price and crush his revenue. And we should be, of course, producing our own. We should be flooding the field with energy. You cannot crush revenue by sanctioning volume, because they will more than make it up in price. Imagine we were successful when we took 50% of Putin's fossil fuels off the market. Would the price of oil and gas more than double? Of course it would. It's just arithmetic. We've been
always a pleasure. Now, Martin, there's one question here on YouTube. What does Doomberg think the energy mix will look like in 10 years? I'm like, I'll leave it with that final question for you from Martin Gonzalez.
I would say almost exactly what it looks like now, with a touch more nuclear.
Got it. Doomberg, thank you very much. Our good friend from the Coop.
Who else but Grizzle could bring Doomberg back to Twitter, even if it's just on live?
Yeah. Doomberg, thank you so much. Always a pleasure. And we'll see you at the next one. It's a Commodity Con is not so far away.
Awesome. Thanks, guys. Always a pleasure, and appreciated it.
Thank you, Doomberg.
Thank you. All right, everyone, don't go anywhere. That was Doomberg, but we have another very well-respected uranium investor. They put out some of the best research on the uranium industry. This is Goehring and Rozencwajg Partners. We'll be right back.
Hold on. Guys, there's hats. There's mining hats. There's uranium hats. Guys, hit the retweet if you're on Twitter. Get this going. I'm going to pick a bunch of people. Tell us the hat you'd like, and hopefully you win. And then say ditto for YouTube. Bunch of people on here. This is like stacked. Like we're busy on YouTube, Twitter, guys. Everyone, thank you for watching.
Yeah, thank you for tuning in.
Make sure you hit the like on YouTube. This is coming.
This is coming in. It's a little later today, but this is what we got right now.
Yeah.
So either one. So we'll be right back in a few minutes with Goehring and Rozencwajg. All right, Grizzle, Uranium One-on-One. We're very excited to speak to our next guest. It's Leigh Goehring. He's the founder and partner at Goehring and Rozencwajg Associates. If you don't follow them for uranium, you're doing it all wrong. They write some of the best fundamental research on that and other commodities. Leigh, thanks for joining us today.
Oh, well, thank you very much, guys. Thank you.
Leigh, always a pleasure. I'm glad we can make all the technology work, get you on, and you know what, we've got you as our keynote closing because we always leave it open ended for one of our favorites. Thank you, Leigh. Appreciate it. You know what? I still remember the fact that you were conceived on an Exxon tanker.
Oh yes, I know. There is some truth to that. Some truth to that. So
it was actually, Leigh's parents, they were at Exxon, right? They met on Exxon.
Yeah, it was a refinery, not a tanker.
So. Oh, a refinery. You heard it here, everyone. Yeah. Don't get your stories mixed. All right, Leigh, let's dive right into it. So you published some of the most comprehensive supply and demand analysis on the uranium sector. So I wanted to ask, based on the data you look at, what inning do you believe we're in the current uranium bull market?
Yeah, I think that what we're in is we're probably in the third inning right now. Obviously a framework that you can use to try to figure out this uranium bull market is the uranium bull market that existed from 2002 all the way to 2007, where uranium went from basically $9 a pound all the way up to $140 a pound. And just on price alone, you look, we're not anywhere near 140 yet. We've just broken through 80. So if we think that the 2000s was a framework to look at the uranium market, just on price alone, we're only halfway through. However, there's a lot of things that are different between the uranium bull market that is now unfolding in front of us and that bull market back then. Let's look first from the demand side. And I'm going to tie some Goehring and Rozencwajg research into this because, like, as the Grizzle readers and listeners might know, we pride ourselves in our research, and one of the things we do is we like to put together frameworks for bull markets right at the bottom. And most people don't try to pick commodity market bottoms because for most people it's a career ruiner if you get it wrong. But we've done it enough over time that we believe that it's really worth on a risk reward basis to do it. We don't always get it right, but the uranium market is a classic example of where we applied our research skills. We turned bullish right at the bottom, and we've been following this bull market. Oftentimes we're a little bit early, but our research told us we were going down the right road, that a bull market was right in front of us. And indeed, now what's happened is everyone has recognized that the bull market is now in full force. And just to show you, at Goehring and Rozencwajg, what we try to do, not only from a research basis, from an investment standpoint, is that everyone loves Cameco here at $60. Back in 2018, when we turned bullish in the first quarter, Cameco in Canadian dollars was a $10 stock, and it had no net debt, it had $1 billion of debt, it had $1 billion of cash on the balance sheet, and it traded at a 20% discount to book value. That's why we like to get involved. And you even take something which is a no-brainer, like the old Uranium Participation Corp, which is now Sprott, the Sprott Uranium Trust. You could buy that as much as you wanted at $7 a share, and now it was 24, 25. People were clamoring to get it. So that's why we like to get involved at the bottom. However, one of the things we do is when we do all the research at the bottom, we put together a roadmap of how will this bull market unfold. And so what we do is we put road mile markers and road signs by the side of the road as we travel down the path of this bull market to make sure that we're indeed going in the right direction. And so far we are heading hugely in the right direction, and all the indicators that we look at point that the uranium market is going to progress significantly higher. Now back. What's the difference between now and 2002 to 2007? First, from the standpoint of demand, like one of the things that we've done at Goehring and Rozencwajg based upon our research is that we have done a huge amount of research on renewables. And when Adam first came to work for me 17 years ago, I said, Adam, we want to do our research. We want to we want to make our investments based upon that research. Then we want to put that research in the public domain. And then within 2 years, we want to have the headlines of the Wall Street Journal and the Financial Times basically confirm what our research said. And that's exactly happened with renewables. We decided simply that renewables under any circumstances just don't work because of their incredibly poor energy efficiency. So if you believe that, if you're a believer that carbon is significantly influencing the climate with very, very negative results, what that means is that the standard renewables and the trillions of dollars that have flowed into those renewable investments, primarily solar and wind farms, will never accomplish what they're trying to accomplish, which is what's that? Try to provide cheap, clean energy and at the same time reduce the amount of CO2. If you use our investment framework, which if anyone's curious, go back and read our quarterly letters. It's all in there starting about 4 years ago. That these renewables will never accomplish their stated goals. And when you finally do the correct analysis about the amount of CO2 that will be produced, because of their incredibly low energy efficiency, that you'll wind up actually producing more CO2 than if you just burned hydrocarbons. That is playing out right in front of us right now. So if you believe that renewables will never, ever solve the CO2 problem, which they will not, then there's only one solution, and that's nuclear power. And at first, when we started to write about nuclear power and the demand for nuclear power, we talked about this, and we said, there's actually there's a great podcast that Adam and I did. It's on YouTube called The History of Energy. I'll recommend you to look at it. We say there's only one solution to this problem, CO2 problem, and that is nuclear. And now what's interesting about that is being accepted by almost everyone. The COP28 conference is going to start tomorrow in Dubai. And at that, the United States is going to announce a pledge to triple the production of nuclear powered energy by the year 2050. Now, that's incredible because, we're talking about tripling uranium, tripling uranium demand between now and the next 25 years. So the underlying demand for uranium now is going to wildly exceed what our original modeling predicted back in 2018. So the thing is that this idea that nuclear power is part of the solution is being adopted by anyone. Look, everywhere. Sweden, which of course has been one of the great countries that has put a lot of money into renewables. They were going to be quintessentially Greta Thunberg green and things like that. What have they done? Their environmental minister just several months ago made a big presentation where they said the only way that we're going to satisfy our energy demands going forward with the reduction of CO2 is going to be nuclear power. We're going to double the amount of power that we're going to produce from nuclear power, or basically build 10 new reactors. So you're seeing this adopted everywhere. Oliver Stone, who is the hero at the Davos, the 2023 Davos country this year? It was Oliver Stone. He came out with this new documentary. Again, how in the world is the world going to meet its CO2 reduction goals? There's only one way. And everyone here at Davos who you've been taught to believe in windmills and solar panels, you have to give that up and you have to throw your lot in with nuclear energy. And by the way, it's the safest means of producing electricity energy that there is, contrary to what the general feeling is out there. So the thing is that we've had this huge. One more thing. John Kerry, who 2 years ago never mentioned nuclear power. Always, more windmills, more green, more solar photovoltaic farms, etc. Even he now is promoting it as the solution. So the idea, could we triple uranium demand? It's not in our models. We're just go back to 2008 in our models. That back then said there's a significant, what we call structural gap, that has emerged in global uranium markets. Even back then, it was being masked by all that excess inventory post Fukushima that was still kicking around. That once that was finally consumed, which it has been now, that we realized the structural deficit is in place. Now, that structural deficit is going to probably get wildly greater because of this demand issue, which I pointed out, which is not in our original models. Now, from the supply side, 2000, the 2000s is when the National Uranium Company of Kazakhstan decided to really ramp up their uranium production, and basically over between the mid 2000s to the 2015 2016 they almost tripled the amount of uranium produced. So you had this huge, almost a supply side shock come on at the same time that the Cigar Lake mine was also being developed and ready to come on. Ironically, almost just a little bit before Fukushima happened. So you had this big, huge expansion in supply at the same time that demand was going to take this big hit. Just the opposite today. Demand is going to grow tremendously because of everything I've just said, and the supply issues are going to be very, very muted between now and 2030 on what can come on. So that's the underlying backdrop. How high uranium prices can go in this bull market, we'll have to wait and see. But it's only now that people are realizing that there's this structural gap that is developing between supply demand, and it's based upon the incredible interest in the building of new nuclear power stations, which is all now being adopted because of CO2 environmental reasons. That structural gap is going to get much, much bigger.
Now, Leigh, if I wanted to sum all that up, it sounds like, if this was even just a typical destocking phase like we had 2002 to 2007, there's still lots of room to run. But you think this is different from a demand perspective because it is a secular growth in demand. Nuclear is back in vogue. People appreciate that it should be part of the renewable mix. And that wasn't happening in 2002 to 2007. And we still got the price increases that we got.
Yeah, I mean, it's interesting. The price increase back then was because of cessation of supply, primarily coming from the winding down of the megaton to megawatt deal with Russia, where the Cameco had agreed, or I should say centrists had agreed here in the US to basically buy all that step down weapons grade uranium and then distribute it into the market back into the 1990s, into the early 2000s. And that agreements eventually came to an end in the early 2000s. And that's what caused the big drop in supply, which people didn't quite anticipate. And that's what caused the bull market. But as far as demand, there was almost very, very little in the way of new demand that came on during that time period. So there was some, but not a lot. So that was primarily a supply issue in the winding down of the megaton to megawatt deal, a deal that had been concluded in the early 1990s as a way to deal with the huge amount of weapons grade nuclear material that was knocking around Russia. So that was the basis of that bull market. And of course, that ended in 2007 for a variety of issues, including the big, huge, before Fukushima, including the big, huge ramp up that had begun to take place in Kazatomprom's uranium production. So this time it's different. You have it both from an incredibly strong demand profile going forward, and supply is going to be muted, at least for the next 7 or 8 years.
Now, Leigh, I wanted to get your opinion on reshoring. Like, do you think, is there an opportunity for the U.S. or North America to step in from a production perspective from where it's been to almost no production is happening in this part of the world, like with geopolitics and everything? What do you think about the potential there? Is there potential?
There is potential, and ultimately this uranium bull market will come to an end, not from the demand side, because remember, demand for uranium is almost inelastic because no matter how high the uranium price goes, it's not a big part in a utilities cost structure. It will take place on the supply side. So that's something to really monitor. But as far as the U.S. goes, people forget in 1980, who is the world's largest uranium producer? It was the U.S. The U.S. produced 40 million pounds of uranium. And what's interesting is that all that production, most of those producing sites in the U.S. are still fully permitted and ready to go. And what they really need is they need higher prices. And the way we calculate it is that for it to get a really robust rate of return on all these most of them are all in situ leach in Wyoming, Texas, and some in Arizona, that what you need is a $70 uranium price, and now we're through that. So the U.S. and the U.S. production is coming back. For example, UR Energies, their Spring Lake project, is now ramping up, and ultimately will produce 2 million pounds of uranium in the next per year by in the next several years, and Wyoming at its peak produced 14 million pounds, and there's a lot of interest in the various projects that are there to be put online. So the U.S. will, and Texas is pretty much ready to go. So will we see eventually a ramp up of U.S. production between now and 2030? Yes. We'll just have to monitor how big it could be, but it could someday be, if there's a huge investment boom in the uranium production space, that the U.S. could produce somewhere between 30 to 40 million pounds of uranium by some point in the next 15 years or so. But again, that might be very well needed to supply this big surge in demand that may occur.
And Leigh, just on that point again, the timeline this comes on, coming back to your original point, we're in the third inning from your perspective. Like, this is all going to take time.
Oh yeah, we're not. We're in that period right now where there's going to be no supply. I mean, for example, the only supply that could come on right now is going to be Paladin's Langer Heinrich mine, which was closed in the last cycle because of low prices and went bankrupt actually. And the company Paladin's reorganized, and that's 6 million pounds that could come on in the first part of 2024. There's other sprinklings here or there. The Honeymoon mine in Australia could eventually, which was shuttered again in the last cycle because of low prices, could come on as 2 million. The big short-term one is that Kazatomprom has talked about bringing on about 15 million pounds in the next 2 years in market. I find that very, very unlikely, given the fact that the various production bottlenecks that will take place trying to ramp up the production. So that's something to watch, but I think that's being a wildly optimistic projection on their part. The big new source of supply is going to be 2028, maybe, is going to be the Arrow deposit by NextGen. That's a super robust project that is, it's not fully permitted, but they're awfully close to their final permits. Great PFS on it. Full feasibility study with huge robustness at $50 uranium. That's going to come on 2028. They say. I doubt it. I would put 2 years of delays in that, but that's going to be somewhere between 20 to 25 million pounds of production. So there is going to be a supply response. However, it's going to be at first just be needed to fill the structural gap, which is already developed. And like you said, I know there's a question you said you put forward about how the financial speculator is going to get involved in all this, and that could really mess things up.
That's what I wanted to ask, because we were talking to Sprott, who has the Physical Uranium Trust, and he was saying how the mechanics work is when it trades at a premium, he can then raise money to buy more uranium. So I'm wondering, could we get in this cycle where investors say, I want access to uranium, I'm bidding this up premium, he then issues money, buys more uranium, that drives uranium higher? Can you get in this type of cycle?
Oh no, of course. In fact, we've already hypothesized. We've written about that. That was one of the big issues that could develop, is that the hedge fund industry learns to game the uranium market by playing games with the Sprott Uranium Trust. Like you said, get in there, drive it to a premium. They issue shares. They take that cash. They want to buy uranium, and they don't want the uranium on their own. The cash on their own balance sheet. They want uranium. They're forced to go out and bid up the spot prices in order to get rid of the cash. That's a game that no one is playing yet. However, given the hedge fund industry, I know it very well. I worked in it for years. This is the type of game that they will discover and love to play, and that's in the future. But it's interesting now. The hedge funds have. It's only in the last month that they've actually started to get involved. You read Bloomberg, and like they're all uranium bulls, and actually they steal our language. They take the term structural deficit, which I've never seen anyone use before, and they spout it out in their Bloomberg articles. Cameco's in that position now, but it's so funny. They haven't discovered this game. The Sprott Uranium Trust, it was only 4 months ago the Sprott Uranium Trust traded at a 15% discount to NAV, and I mean that's how bearish people were. And no one had an interest. So that's going to change. But you're dead right. We have to go through that whole cycle of the hedge fund industry, learning to use the Sprott Uranium Trust as a great way to play this game. And remember, what's interesting about it is you go back to 2002, 2007, the hedge fund industry actually got involved back then, started to, except it was a very, very what I would call a clunky trade. They had to go to Cameco, they had to arrange for Cameco to store the U308 for them and all that sort of thing, but they did it. And one of my favorite things is that when Lehman Brothers went bankrupt in 2008, what did they have on their balance sheet and asset? They had 15 million pounds of uranium. They're playing the game too. And so they're going to come back. They're not in there now playing that game just as you described, but they will. I'm convinced of it. And it's going to be another, as the financial player gets involved, it's going to be another source of unanticipated demand that's going to enter this market.
And we didn't have that in 2002 to 2007. They had to do it the hard way of what you're describing, right?
Yeah. They could have done it with the old Uranium Participation Corp, but that was not what Uranium Participation Corp did. It was just strictly to be a price tracker with the uranium market. And every once in a while, when it did trade at a significant premium to net asset value, and they were comfortable with that, they would issue new shares to try to bring it back. But that was not the point of the fund. The point of the fund of the Sprott Uranium Trust was originally to buy all that Fukushima excess inventory, which they have successfully done. And that's they kicked off the bull market. There's no two ways about it. And it's what I said, like you said before, what's going to happen is the hedge funds are going to learn to use the Sprott Uranium Trust as a great manipulative device to the uranium market.
Now, I wanted to ask about small modular reactors because we got some news where NuScale, they canceled their small modular reactor. And they were kind of the furthest ahead. They're working with the government. I'm wondering, is that a setback for adoption and construction of SMRs? And secondarily, the demand you're talking about, most of that's not coming from SMRs longer term, right? So this type of, if it is a setback, I'll get your opinion. It probably doesn't affect the demand over through 2030.
And just to add to there's a lot of chat on YouTube asking about exactly this. So I'll let you. It's a hot topic.
Yeah, it is a hot topic. It's very interesting. We're big believers in the whole small modular reactor, and we know a lot about it. My partner Adam is probably one of the few people that has spent days at the labs of TerraPower, NuScale, meeting with all of the scientists and engineers, learning everything about it. And there's a big difference between the various technologies. Like for example, the thing about a NuScale reactor, it is basically a scaled down version of a Westinghouse AP1000 reactor. And all the problems that you have with a Westinghouse AP1000 reactor, you're going to have with this reactor as well. And what are those problems? The idea, water boils at 100 degrees C. That the reactor core will get as high as like 450 degrees C. And so the only way you prevent the boil off of that circulatory water is to keep it at I think it's 100 times atmospheric pressures. And what you need to do is you need incredibly thickness of steel. You need incredible thickness of concrete to put that massive amount of steel on. And you need, incredible precision for all your welds and joints and things like that. So the thing is that, and NuScale, their story is that, look, since we're going to basically be manufacturing these in a factory and not on site and then shipping them, that's where our cost advantage is going to come from. Now, that is going to be very difficult to do. However, it's laudable. However, TerraPower is completely different. TerraPower does not use water; it uses sodium. And one of the things about sodium is sodium boils at 700 degrees C. So even if you lost circulation in a small modular reactor with a sodium-based coolant, you would never boil off the sodium. So the thing is that what that does, it allows you to do two things. It allows you to build all your circulatory infrastructure and with much less steel, because you don't need the thickness, because everything's since it doesn't boil, it never has the risk of boil. You can keep everything at atmospheric pressure. And second, you need a huge amount less cement. So the thing is that it's a different reactor. Now, also, what's interesting about the TerraPower reactor is that we're a big believer that a new technology that has superior energy efficiency will displace the old technology, and if it doesn't have superior energy efficiency, it will never displace the old technology. That's why the EV will never displace the internal combustion car, which is another topic for another day. You're actually seeing that right now, is that all these lots are filling up with EVs that people don't want. There's a very specific reason for that. However, with the TerraPower reactor, it has huge, since you're using huge amount less steel, huge amount less concrete, and you don't have all the huge amount of energy put into the specification, the welds, joints, things like that, that you wind up with an energy efficiency, energy return on energy investment that's literally almost like 80% higher than an AP 1000 Westinghouse reactor.
Wow.
So this will ultimately displace high pressure water reactors because of its energy efficiency. The biggest risk to TerraPower is the nuclear regulatory agency in the United States. So whether they actually get around to granting approvals for this. So it's an interesting thing to watch from an energy efficiency, energy in return on investment, energy invested. It is superior, and we believe it's the way of the future. And like I said, all you have to do is get around to the NRC actually giving its final approvals. Now, mind you, sodium-based reactors have been around a long time. So in fact, there's one been operating in the United States. It's closed down. They've operated for almost 30 years continuously with absolutely no problems. It's not really a new technology. It just hasn't been used. And if you study the history of the adoption of uranium nuclear power generation, the reason we went water-based is because all the original research was done back in the early 50s with General Rickover of the Admiral Rickover of the Navy, and we just adopted that.
Wow, so it sounds like we should really be watching TerraPower more than NuScale. NuScale isn't really a bellwether as much as maybe people thought when they first heard the news.
Yeah, our belief is that NuScale is not doing anything really different. It's just using standard high pressure water cooled reactors, and they're hoping to get a cost advantage by basically manufacturing them in a manufacturing facility. Whether that overcomes the huge drawbacks to having a water-based reactor, we'll have to wait and see. But TerraPower is a real game changer.
Gotcha. Do you have?
Well, so Leigh, you've fantastic overview here, and I'd be amiss if we have you and we didn't talk about the energy complex as a whole. Leigh, what are your thoughts here on oil and just broad takes, and would love to get your feeling on where we head into the end of the year and out into 2024.
Yeah, I think the big trade in 2024 that's going to be the real shocker is what's going to happen in North American natural gas, both here in the U.S. and Canada. The natural gas market, ever since 2007, 2008, when the shale gas revolution really began to crank, has been in what we call structural surplus, and it's still in structural surplus today. And that's why you have a situation where North American natural gas trades below $3 an MMBTU, and the rest of the world it trades basically $15 to $16 an MMBTU. And so we believe that the natural gas market is on the verge of, for the first time in all the way since 2003, 2004, swinging from structural surplus into structural deficit. When that happens, the North American natural gas price is going to surge from $3, basically up to the world price, probably overshoot it. So anywhere between $12 to $16 an MCF. So the thing is that to me, that there's a huge certainty on this trade. We wrote first about this. Like I said, in our research, we're always early. And the uranium, we turned bullish right at the bottom in uranium, when uranium just bounced off the bottom at $17 a pound, and we had to wait 2 or 3 years for people to come to our view. We wrote our first hugely bullish convergence natural gas piece in the first quarter of 2022. So we ran to 10, gave it all back. Some things happened. However, again, we put forward this roadmap in which you travel down, that we have mile markers and signs. We're passing all the mile markers as far as supply. The shale gas revolution in America, we talk about uranium, the bull markets, and the third inning. In the shale gas revolution in the United States, we're in the bottom of the ninth. And the thing is that supply is going to stagnate and then potentially roll over the next couple of years. At the same time, we're going to bring on 6 BCF of new LNG export capacity here in the U.S. by the end of 2024. There's no way that we can meet that new gas demand, and the arbitrageurs are going to bid that U.S. natural gas molecule, which now trades at an 80% discount to the world price, up to the world price, which is basically BTU parity with the international gas. So the thing is that's my favorite short-term trade. It's obviously hugely influenced by what happens this winter. Whether we have a cold winter or not, I don't know. I'm an amateur meteorologist, but the models, as usual, are completely conflicted. So really, I don't have an answer. So that's my favorite trade. Now, here's something interesting. We're a big believer with oil, that oil is on the verge of becoming what was deemed almost a universally accepted belief 4 years ago. It was an uninvestable asset class. And we believe that oil is on the verge of swinging from being uninvestable to must own. And I could, if I had more time, I could give you a great example of that's happened in certain corners, very dark corners of the energy market. If you're a royalty investor, Permian royalties have surged by almost 5-fold in price in the last 6 months or 8 months, and it coincides with the fact that Exxon buys Pioneer Natural Resources, the premier Permian player. We're starting to swing from an asset class that is uninvestable, that no one owns, that people are going to have to start to accumulate it. And obviously that's oil. And why is that? Because oil too is on the verge. We're going to recognize this, and we would make the case that it's on the verge of being in structural deficit right now, and no one knows it. And just like uranium was in structural deficit in 2018 and 2009, and no one knew it because uranium, the Fukushima inventories were still sitting on top of that market, being liquidated. What's happened now is in the last over the last year and a quarter, year and a half, the U.S. has released, and Europe and Japan as well, has released about 320 million barrels of oil out of the strategic petroleum reserves to make up that structural gap which has already emerged. And we believe that 2024 might be the year that we realize that the market has switched into structural deficit. So we're bullish on oil, but on a short-term basis, we're really bullish on natural gas, and we believe that convergence, it's a function of weather. We have a really cold winter in North America. It could happen by March, April. If we don't, then we'll have to wait for that 6 BCF of new demand to fully materialize by the fourth quarter of 2024. But it's a great trade, because the gas price could wind up going up 4 or 5-fold.
Oh, I like you, Leigh. I like that. As you know, we're natural gas bulls, and always great hearing, a fellow bull that has done their work, and Leigh, you always bring great insight there. Now, Leigh, I just to wrap up on the uranium side, one question I didn't cover is, how are you playing this? Because obviously, uranium's a different beast where you can really play it through these physical, the Sprott Uranium Trust, or you can play it vis-a-vis the uranium equities. And how are you seeing the continuum happening? Obviously, in the early innings, Sprott maybe does some heavy lifting, but where we sit right now, do you go larger cap, or how are you guys positioned?
Yeah, I think that what you want to do for the average retail investor, you probably just want to buy the uranium, either the Sprott Uranium Trust if you're North American based, or if you're European based, you buy the yellow cake trade trust that trades in London. I don't want to recommend individual stocks, but there are Yeah, there like I mentioned before how the U.S. is going to swing from being a zero producer to being probably a significant producer by 2030, and a lot of these companies do have fully permitted uranium projects that can come online. So I think that some of those are very interesting. There's about four of them that we all know very very well. So I would say investors could take a look there. There are some Canadian companies that have some really, really robust projects. I mentioned at NextGen in the phone earlier, the call earlier, and Denison Mines, the Wheeler project. That's another. It's got some issues because they've only done a PFS. They have to do a full blown feasibility study, so there's some issues there. But that's another robust project that could come online. And of course, the big names. Cameco, things like that you might want to wait in is as far as those as well, but
Yeah,
do it a diversified way.
Leigh, I totally appreciate it, and always such a pleasure, to have you at our conferences, shows. Always great. I really appreciate the partnership.
Okay, great. And I'm very glad I could participate. Thanks a lot, guys.
Thank you, Leigh.
Okay.
All right, everybody. Uranium one-on-one. We're coming close to the end, but we got a little bit of stuff from us.
Yeah, absolutely. So we're gonna do a quick roundup of just what we do at Grizzle Research and Quant. That was a phenomenal just schedule here. Now, Scott, we should just kick right into it. I don't know if we have do we have an intro slide for ourselves? We may or we may not. But we're happy to kick into it, guys. For those who don't know, we have a first of all, thank you so much for everyone for joining. And we're gonna end with just what we our added bits to the uranium.
So some of the work we've done in uranium that may be a little differentiated.
Exactly. And first of all, if you've liked what we've drawn today, please do give this a thumbs up on YouTube. There's a ton of people out there. Hopefully you guys will give the thumbs up and share this, share it widely. But secondarily, make sure you sign up for our research. We are very fortunate to have Chris Wood as our Grizzle strategist, and we put out he puts out a missive free on Grizzle. It's you'll find the link on YouTube. It's Grizzle Research, grizzleresearch.substack.com. Sign up there. You get that. And then in addition to that, we have our Grizzle Research and Quant offering that basically we're going to run through right now. And so, Scott, maybe we'll, at a high level, why don't we talk about how we think about the world through Grizzle Research and Quant?
Yeah, so Grizzle Research and Quant is combining quantitative analysis, which can be very powerful, but we think you have to tie it with fundamental research because that's where the differentiation comes from. Because quantitative, there's some unique things you can do, but it's easier to do, and it's being done by some big hedge funds with lots of capital, lots of resources. But the fundamental research is where you can take a different view on things, and then you tie it with the power of quantitative, and you can do some very interesting work. Yeah. So that's basically what when we come at these different ideas and different sectors, we use that background, then come up with stock ideas, different screens. What we've done so far is just a lot of different high value screens that'll give you both ideas and lists of ideas. Yep. So we've, taken a big group and narrowed it down to what we think are the best ideas so that you can kind of start there with a strong base.
Yeah, and that really is like when we think about quant and fundamental quant, the way we really bring that insight is through the fact that these are undercovered sectors that require unique expertise, commodities in particular. So they need a new lens that's not out there, like it's not out of the box, take high PE stocks, low PE stock. This is, we're talking about uranium. You got to roll up your sleeves a little bit more. You got to do more work. And that's what we've really encapsulated. So what you will find is our piece, if you go to Grizzle Research and Quant, it's what's the title of the piece that we?
I'll look it up while we're talking.
Basically, it's if you go to Grizzle Research and Quant, the top piece there, and we're gonna kick on it right now. So bear with me. I'm just gonna get. So you're gonna see a couple pieces that we put out. The top piece is that's the highlighted piece is quantifying the sweet spot for uranium stocks, and that is basically our take. That what we're trying to do is basically highlight the stocks we believe take us into the next inning. And so, Scott, why don't we bring up the first chart?
Yeah, we got a few slides to show you kind of the background research and what some of the conclusions are.
Yeah.
So this is kind of the good encapsulates the whole idea.
Yeah. So what we did here is we looked back in history and we said, listen, let's take a look at what the last real bull market, basically it was 2003 to 2007. Cameco is the bellwether. That's the yellow line there, right? And then what we then looked at and said, listen, if you're a uranium investor, chances are you own small caps, right? And then we categorize that as the bottom 50th percentile of stocks. And what was interesting is if you look at the last bull market from July 2003 to March 2007, what you notice is similar, it's similar to what's happening today, is that Cameco ran first and ran hard whilst the smaller caps lagged, right? And that when you think about a commodity that's doing really well and goes up in price appreciably, what you rarely see is where the small caps kind of lag. You tend to see them actually start to work better pretty quickly. But in uranium, it's unique where the money tends to go right to Cameco right away.
The producers first, the ones, because if the price goes up $1, Cameco's producing, and they'll get a piece of that dollar faster than an explorer who's not yet producing.
Totally, and the market is slow to accept or appreciate that a new paradigm has come. And if we pull back up that chart, I'll bring that chart back up. So when you see in the shaded area there, you notice this inflection point of the blue line, which we believe we're in today. But this is in, just before, to the end of March 2007, you see this period of like 8 months where basically the small caps just went tonto. And then when you look at the entire bull market period, small caps outperformed Cameco significantly, right? So Cameco was up 800%, and through that entire period, small caps were up 1,200%. So now let's fast forward to today. The bull market started in March 2020, and again, we're seeing a period where now I think it's accentuated even more, is that Cameco has significantly underperformed the small caps. Outperformed the small caps, and so to a point right now, if you kind of were to take a sentiment gauge on Twitter, the general feeling on Twitter is that, listen, throw in the towel. It's, let me just, Cameco, and that's kind of it. And, this is
or physical uranium.
Or physical uranium. And again, bigger picture here, we feel that this is very much like the last cycle, that we will see this inflection point come through. We can kill that graph.
Yeah. So I hope you guys, if you've been listening to some of these other speakers, you see it's still early innings in the overall uranium supply and demand. And with that type of backdrop, it means that small cap trade hasn't played out, and you still have a lot of that to catch. And so that's what we've been really digging into. Maybe you want to talk to the next slide that just looks at, there was a little group of the small caps we found that was even more supercharged.
Yeah, absolutely. And so, okay, so that is one thing, right? So you have this dynamic where, okay, listen, it's kind of nice because what you get is you get a leading indicator with Cameco. So now you can play it with more oomph, if you will, through the small caps, because that there's this huge catch-up trade to be had. But interestingly enough, if you took at the bottom 50th percentile, so there's the top half of market cap and the bottom half of market cap, that obviously that did well through the period, 1,200%. But what did exceptionally well was this green line that trounced both Cameco and the bottom 50 percentile, which was actually this meaty middle of the 25th percentile of market cap to the 75th percentile of market cap. And that went up in excess of 2,700% in the entire last bull market from 2003 to 2007.
That's quite an outperformance.
And so that is us, and we can kill this slide, but that green line is the most important line there. But the key takeaway here is when you're looking at your uranium stocks, you want to make sure they sit in this, in this sweet spot, right? But then further to that, we then overlay fundamentals, which is Scott's going to talk about. Well, why exactly is it this 25th percentile to 75th percentile of market cap that does exceptionally well? And why isn't it the very, very small guys or the ultra big guys, i.e. Cameco? What's unique about this middle area? And Scott's going to talk through that, because this is the most important part. It's that kind of idea that listen, let's look at quantitatively, look at the history of uranium, understand where we can draw parallels, and then let's dig deeper and find companies with the same DNA that could work in this cycle. And this is how you basically enhance your odds of winning on a relative basis.
Yeah, because what's interesting here is usually you think of risk reward goes hand in hand. So if you're buying the smallest, riskiest explorers, there should be the most potential upside, but there's also potential a lot of downside. So what we've seen is in that bottom 50 percentile, there's some really small, really risky companies that might have not worked out for people, and that dragged down the overall return versus that middle. What we think we found is it's the companies that are closer to production and developing an asset, so they've somewhat de-risked. Mm-hmm. And so there's a important chart that I'll throw up here that basically what you find is the more resources you have and reserves, the higher your market cap. So the market, obviously, they want to see that you have uranium you found. So that may explain why that middle ground, the guys who have already done some exploration, they've had success. What they've done is they've been successful at finding even more pounds and then developing those pounds and producing them. So they're getting credit from the market. And so we've taken out those explorers. Obviously some hit it big. You're going to make a lot of money, but there's the risk that some don't, or they run out of money, or their project, just the permitting doesn't come through. So you've taken out all of those risks. And so I think that explains why you want to be kind of in the middle, where they've found resource and then they're growing the tonnage. You're going to get the valuation upside from that. And that plays out in the last cycle. And we think it will again. So you can kill this slide.
Yeah.
And then what we've taken in that article that we're referencing, we did all this work. Then we take it the next step further and say, based on these different metrics, valuation, what they're doing, our insiders buying and selling, share dilution over time, all these important things. What are the best positioned companies in that middle for this cycle? So then again, we're setting you up where you don't need to buy all of them, but we've cut down the industry from say 150, 200 names to say 15 good, high quality ones you can start with to build your portfolio.
Yeah, exactly. And Scott's nailed it, right? Like they have the characteristics of everything you want. Now, again, once you do that next level of due diligence and say, okay, well, listen, I don't like these two things or about this company. I like this better. But the main part is that you just really need to whittle this whole pool down to a set of companies. Now we've had we're very fortunate to be plugged into some great minds in the uranium sector. We've had great feedback about how we can take the next chapter. We're about to drop that in the next week or so. So if you are signed up for Grizzle Research and Quant, you'll get that. In addition to that, you're gonna get Chris Wood's weekly, and we're always thinking about ways quantitatively that we can capture alpha in the commodity and growth sectors, where we ultimately know that there's inefficiencies in the market, mispricings that your generalist just can't get to, because you need to have a specific view. Like the way Scott's presenting this, like you need to be really digging into uranium to figure that out. That's not going to be like on some random PE screen, because again, our entire conference today, Scott, would anyone be even in uranium equities if they were just like by PE? Like you wouldn't even touch Cameco.
No. Yeah. It's much more than just the valuation, which is not differentiated. Anyone can pull that up on Bloomberg. It's about digging in and understanding first supply and demand. And then look, you need to be a student of history. And so that's what we do. We look back at other markets, other runs, and learn things from them, and then try to apply those to the future. And then dig through lots of numbers and fundamentals to try to come up with a differentiated view.
Yeah, exactly. And again, and we also throw the gift the market gives is the options market, and you can take both sides of that, right? You can be selling volatility. If there's an opportunity where you feel that the stock is underpriced, you can get leverage into that. So we think about it a lot of different ways. But right now, specifically as it relates to uranium, we had a phenomenal cast of experts really give the thesis why we're sitting here and why everyone's listening.
and why it's such an exciting time to be in uranium. I mean, you guys who are tuning in are actually ahead of a lot of the big institutional investors, and that's an exciting feeling.
Exactly. So please stay tuned for the coming weeks. We're gonna continue to build out what we've done quantitatively on the uranium side. It is as Leigh said correctly, and as Cuppy had reiterated, we're still early days here. Third inning with respect to where we can get to. And I think third inning's a great place, Scott. Like, I love third inning because
you don't want first inning. It's too early.
First inning, well, listen, we've all sat through first inning. And
there's been some great games already, first inning to third inning. If you look at some of the individual stocks, even Cameco. But that just shows that there still could be a lot more to go.
Oh, for sure. And the problem with first inning with a lot of things, where like, the way you can only put so much capital because you still don't know where the catalyst is going to come. Like, I'm talking, you're still on the batting mound or whatever, right? You still haven't come into the game yet, and you don't know when the game starts, so you can't devote a lot of capital to it. The nice thing about being at the third inning is that the story started, right? I'm not at the eighth or ninth. I'm not sure if the pitcher's going to get pulled out early. I don't have to worry about an early ending here. The third is nice because you got a sweet spot of several chapters in front of you, several acts still to come, and something we've executed well in time. It's been something that's worked for Grizzle over and over again, is the catch-up trade. Like, when Scott and I see a catch-up trade, the first thing we're like, listen, how can we eat a lot right now? Because like, if you know that, a certain set of stocks, a certain stock has moved up, and there's a valuation disconnect, and specifically if you can prove it in time. Let's go back to that second slide, and you sure can prove it in time. Uranium's nice because uranium, the commodity, goes through these super spike periods. So when the uranium commodity goes through a supercharged period, what ends up happening is this sweet spot of the 25th to 75th percentile of uranium stocks by market cap. And that's if you just aggregate that entire pool of stocks and say, listen, I own each one of those equal weighted. You trounced Cameco. You trounced the bottom 50th percentile, which is small cap. So if you will, and what you're looking for, Scott, and we can kill that slide. Scott, what's the recipe, and why is that sweet spot, that 25th to 75th percentile, so valuable?
You're taking out the riskiest explorers that either don't get funding or they don't have drilling success. You have people that have already found tonnage, and then they're advancing their development, and they're getting the permits, taking it to production. So they get the benefit in market cap and dollars as they're finding new tons, and then the value of uranium per pound is going up. So it's basically limiting your downside for more of the upside.
Yeah, and the other very important part, why this 25th to 75th percentile works really well is coming back to your point. They've got resources, so it's clear, like, it's not, they've got real resources. And then there is, I followed the commodity market very closely in terms of investors, other commodity investors and other generalists. When you've missed Cameco, what do? Right? The big active portfolio manager at a bank or a big mutual fund, well, he's not going to look like a dummy and try to pick Cameco right at the top, right? He may nibble away, right? But if he's really late for the party, he's got to say, listen, I'm looking for the value opportunities here. And where that value is, well, they have to have a resource, right? They can't be stocks that are like totally off the beaten track. And,
because they're not experts. You have to be basically a geologist if you're going to try to pick the wildcat explorers. Otherwise, these guys they love their PE, as Tom said, they love their metrics. You need resource. Then you can say, what's the dollar per pound of resource I'm paying? And in our note, we actually have everyone that has a resource, we have the valuation of dollar per pound. And that's one of the screens we use to pick the names.
Yep, exactly. So you get two aspects here, right? You get this weight of money. The classic, I was a good friend, Doug Polite, always told me this is the way, he envisioned the precious metals market. And again, when things go bananas, and don't forget, tomorrow is hard money at 10 a.m. It's that classic analog. I've got a pitcher of beer, if you will, a pitcher of whatever, and the market can only, of real investment opportunities. Again, there's a lot of companies that are not real. that's facts. But in terms of real companies that are investable, it's a set of shot glasses, small shot glasses. And so it's that pitcher of money pouring, and then you get this effect. Let's pull that second chart up. This is the effect. When a pitcher, which is institutional investors, try to get into a small group of companies, Zach, it's that green line. That's what happens, Scott. When you have a small group of investable companies that fit the criteria of an institutional investor that has a lot of money and wants to get into the hottest commodity, uranium, you get this green line, the 25th to 75th percentile of stocks by market cap. And then you whittle it down even more and you find some big winners. Guys, we are back at 2.
Yeah, we got to recharge everyone. We're taking a quick break, and I hope you guys have enjoyed everything in uranium. But obviously, in the energy transition, there's uranium and there's also battery metals. So that's what we have coming up this afternoon. Another really distinguished group of people building the battery metals sector. You don't want to miss it.
Oh, it's gonna be great. So let me just round off who's coming up. We have it's a great lineup. And like everyone on Twitter knows, Tracy Schuchart is kicking it off. We are happy to have her join us. That's going to be incredible. We're going to talk about silver and the dynamics around that. Mark Selby, Mr. Nickel. This guy is, he is, the dawn of nickel. And then we've got great copper companies, Hot Chili, Amerigo, phenomenal. Copper is the commodity. There's no question about that. Any which way you want to see the economy, the way the world is growing, you need copper. And then we have added a special final, it's great. Mr. Rob McEwen of McEwen Mining. The guy's a legend.
If you don't know, you don't want to miss this, guys, because he's been building assets and he's been through more cycles than any of us. So he's going to be dropping some great insights on where we are now. We've gotten some big political changes in South America where there's a lot of copper and other assets. So that's going to be a really exciting conversation.
Absolutely. So we got a stacked set of speakers here. And then, you know what? We're going to just do a final run through of our phenomenal partners that made this. There's some great feedback from Twitter. Guys, thank you so much. I'm going to pick a bunch of people from the retweets to send hats to you guys. Well, I'll send you guys pick which ones. We're getting a set made. Hey, listen, even the Doomberg even wanted one. I don't even know how that we have to send it. You know what we have to send him? We have to send him an NFT, man. An NFT.
The real hats are for you guys. He gets the NFT.
You get to send him an NFT hat. But I digress. We're gonna run through the sponsor partner slides. There we go. Praetorian Capital, none other than Cuppy. You heard him, the legend. If there's a way to kick off a conference, you kick it off with Cuppy. That was such good insights. Goehring and Rozencwajg, none other. Leigh is just like. The number of people like Leigh, legend, the man. Yes, he is the man. It is so great to hear from him, and we are blessed at Grizzle to have a close relationship to the GNR family, very close to our family, particularly Chris Wood, who goes back in time a long time with Leigh Goehring, and that's how Grizzle knows Leigh Goehring very well. And the next slide, then of course Doomberg, guys. Doomberg's just facts. It's incredible. Just like if I could pick one green chicken to take over energy policy in the world, it is this green chicken. And 200,000 people are reading his.
Well, there's a reason he's nailed certain big calls since he's been publishing, geopolitics and what the world needs to do, and it's all been going his way. So it's great insights into policy and how that will affect investments.
100%.
And lastly, us truly.
We
got us truly.
Grizzle Research and Quant. We're not going to. You've heard it. But please, if you're not signed up, sign up. There's a free part of it, which is we send our musings. You get Chris Wood, but then further to that, we believe we've created the mousetrap, quantitatively fundamental research to really deliver the ideas that can power up. We're talking the upside that only commodities and growth stocks can deliver. And then finally, a partner that's been dear to us through our commodity conference. We're going to see them in the afternoon. Sprott Asset Management. They got 3 uranium-based ETFs. And the one we've talked a lot about is obviously Sprott Uranium Trust.
Yeah, these guys are always ahead of the curve on commodities, and they provide some of the best exposure you can get, low-cost ETFs and other things. So definitely check out Sprott if you're thinking about getting into commodities in general, uranium specifically.
Guys, phenomenal feedback, guys. Everyone, thank you so much. And if you don't, please, if you haven't retweeted, give it a retweet. Everyone should hear these phenomenal speakers that went through the day. And also, we'll see you in about an hour for Grizzle Battery Metals one-on-one. The world does not, we can't get into a new world without the commodities that base them. And that's mining. That's this. That's that.
Exactly.
Both hats are fresh. We came through with it. And then tomorrow, 10 a.m., hard money. That we've got a stellar lineup back to back.
The only conference mixing gold with Bitcoin. Okay, so you get to hear from both sides. That's what it's all about, is figuring out what comes next. So we'll be back in 1 hour. Thanks for tuning in. This was Grizzle Uranium 1-on-1.